Hey everyone, and welcome back. Ready for another deep dive?
Always ready to go deep.
Awesome. Today we're tackling a question that pops up all the time in equity research interviews.
Oh, yeah, this is a big one.
It is. Basically what we're trying to figure out is how a 0.5% RBI repo rate hike would affect the stock market. That's pretty complicated, right?
It can be, yeah. There are a lot of moving parts, but don't worry, we're going to break it all down.
Perfect. So maybe we should start by defining what the repo rate actually is, just to make sure everyone's on the same page.
Definitely. In the simplest terms, the repo rate is the interest rate that the Reserve Bank of India, the RBI, charges when they lend money to commercial banks.
Okay, that makes sense. So it's like the RBI setting the price for money, right?
Exactly. And when the RBI hikes that rate by, let's say, 0.5%, like in our question, it means borrowing money becomes more expensive for those banks.
Gotcha. So what happens then? Those banks just have to accept the higher rate.
Well, they can try, but what usually happens is they pass that increase on to their customers. So now companies who need loans are also going to face those higher interest rates.
Right, because businesses need loans all the time to operate and grow.
Exactly. And if those loans suddenly become more expensive, it puts a strain on their finances. Think about it like this. You're running a business, you're trying to make a profit, suddenly your loan payments go up. What are you going to do?
You'd probably have to raise prices, right,
Yeah,
to cover those extra costs.
exactly. And when lots of businesses do that at the same time, we start to see this thing called inflation.
Okay, so the RBI raises rates. That makes borrowing pricier. Businesses raise prices, and boom, inflation.
You got it. And inflation is basically a fancy way of saying that the cost of living goes up, everything gets more expensive.
Yeah, I've definitely noticed that at the grocery store lately. Oof.
Exactly. It impacts everyone. And when people are spending more on everyday things, they have less money left over for other stuff like investing.
That's true. If I'm shelling out more for groceries and gas, I'm probably not going to have as much to put into the stock market.
Right. And that reduced investment directly impacts the flow of money into the market. Less money coming in means less buying power, which can affect stock prices.
Wow, okay, so it's like this chain reaction. The RBI hikes the repo rate, borrowing gets expensive, companies raise prices to cover their costs, that leads to inflation, people have less money to invest, and ultimately, the stock market feels the pinch.
You nail it. It's all connected.
But I'm curious, is it always bad news for the stock market? Are there any scenarios where a repo rate hike could actually be beneficial for certain companies or sectors?
That's a great question. And you're right, it's not all doom and gloom. While a rate hike generally means tighter financial conditions, some sectors can actually benefit. Think about banks, for example.
Oh yeah, because banks make money from lending, right?
Exactly. Higher interest rates mean they earn more on those loans.
So it's not a one-size-fits-all situation. Some sectors might struggle while others thrive. It's like a puzzle where each piece reacts differently.
That's a great way to put it. It's all about understanding the bigger picture.
Well, this deep dive has been super insightful. Thanks for breaking it all down. It definitely feels like a crucial topic to understand for anyone interested in finance.
My pleasure. The key is to show that you understand the fundamentals. You can connect the dots and think critically about how these different pieces of the puzzle fit together.
Couldn't have said it better myself. Okay, so picture this. You're at this big investment meeting, right? And everyone's throwing around this term PE ratio.
Uh-huh.
Like, it's something everyone should just automatically know, and you're nodding along like, yeah, PE ratio, of course.
Right.
But secretly, you're like, what is this thing? And should I be looking for a high one or a low one, or what's the deal?
Exactly.
Well, today, we're going deep on PE ratios and figuring out exactly how they work and what they can tell us about a company.
You know what's interesting about the PE ratio is that it sounds super simple at first glance.
Yeah.
I mean, it's just the price of a stock divided by its earnings per share.
Right.
So basically, it's telling you how much you're paying for every dollar of profit that the company makes.
Okay, that makes sense.
But the deeper you dig, the more you realize it's not that straightforward.
Yeah, and I think that's what's so interesting about this whole thing, because our source was saying that a low PE ratio, which on the surface sounds like a great deal, might not actually be such a good thing. So can you help me understand that a little better? Why would a low PE ratio sometimes be a red flag?
Well, you got to think about it from the perspective of the market. A low PE ratio can often mean that investors aren't super optimistic about the company's future earnings.
Oh, okay.
So there might be worries about like revenue going down or competition getting tougher, or maybe even like bigger economic problems that are affecting the whole industry.
Hmm. I see.
It's kind of like, when you see a deal online that's just too good to be true.
Yeah.
You're like, wait, why is this amazing gadget so cheap?
Yeah, there's got to be a catch.
Exactly. There's got to be a catch. So a low PE ratio can be a sign that something's up, not necessarily a bargain.
So if I'm looking at a company and I see a low PE ratio, what are some things I can do to figure out, what's really going on? Is it a good deal or is it a sign of trouble?
Well, that's where you got to put on your detective hat. You can't just rely on the PE ratio alone. You got to look at the company's financials, their recent performance, any news or announcements about them, and even what's happening in their industry overall.
Gotcha. So, is this company facing challenges that are just temporary, or are there bigger problems that aren't going away?
Exactly. That'll help you figure out if that low PE ratio is actually a hidden gem or a warning sign to stay away.
Our source also talked about this idea of buying a share of a company's earnings.
Mhm.
Can you explain what that means in a way that makes sense for someone who's not a financial expert?
Sure. So let's imagine there are two lemonade stands right next to each other,
Okay.
and they both make the same amount of profit each day, let's say $10.
Right.
But one lemonade stand is selling for $100, and the other one is selling for $300.
Right.
Now, the PE ratio is basically saying, how much are you willing to pay for each dollar of that $10 profit?
Okay.
So the lemonade stand that's selling for $100 has a PE ratio of 10.
Okay.
You're paying $10 for every dollar of profit.
Yeah, makes sense.
The lemonade stand that's selling for $300 has a PE ratio of 30. You're paying $30 for every dollar of profit.
I got it. So even though they're both making the same amount of money right now, that higher PE ratio could mean that people think one lemonade stand is going to grow way faster in the future.
Exactly. People are willing to pay more because they think they'll get bigger profits later on.
Let's talk about high PE ratios because our source didn't really go into much detail on that, but I feel like it's just as important to understand.
Oh, absolutely.
So sometimes a high PE ratio isn't actually a bad thing.
Yeah, that's right. I mean, think about companies in industries that are growing really fast,
Hmm.
like tech or healthcare.
Yeah.
They often have high PE ratios because investors are betting on their potential to make a lot of money in the future.
That makes sense.
They're basically saying, we're willing to pay a premium now because we believe this company is going to be a huge success down the road.
It's like those people who invested in companies like Amazon or Tesla really early on. Everyone probably thought they were crazy, but those high PE ratios back then showed that some people believed in those companies even when they weren't that big yet.
Right. And those people ended up making a lot of money.
Exactly. But there's a difference between that and just investing in a company that's simply overvalued.
Well, yeah, definitely. A high PE ratio can also be a sign that a company's stock price is inflated beyond what it's actually worth.
So how can you tell the difference between a company with a high PE ratio that's actually going to grow and one that's just overhyped?
That's the million-dollar question. You got to look at the company's fundamentals, their financials, their management team, their competition, and the overall market conditions.
So basically, you got to do your research.
Exactly. Don't just blindly follow the PE ratio.
Now, another thing our source emphasized was the importance of comparing PE ratios within the same industry. Can you explain why that's so important?
Sure, it's like you said before about the lemonade stands.
Yeah.
You wouldn't compare the price of a lemonade stand to the price of a fancy coffee shop, right?
They're totally different.
Exactly. They're totally different. So when
Uh.
you're looking at PE ratios, you want to compare companies that are in the same industry so you can get a better sense of what's considered a high or low PE ratio for that specific sector.
So if I'm looking at a tech company with a PE ratio of 20
Yeah.
and the average for tech companies is 30, that might be a sign that I should dig a little deeper and see why this company's PE ratio is lower than its peers.
Exactly. It could be a hidden gem or it could be a sign that something's wrong.
And on the flip side, if a company's PE ratio is way higher than its competitors, I should probably take a closer look and make sure that high price is justified.
Right. You want to make sure you're not overpaying for something just because everyone else is excited about it.
So it sounds like the PE ratio is a really useful tool, but it's definitely not the only thing investors should consider.
Exactly. It's just one piece of the puzzle.
What are some other factors investors should keep in mind?
Well, you got to look at the company's debt levels, how much money they owe,
Oh.
the quality of their management team, how competitive their industry is, and even what's happening in the economy overall.
So basically, you got to look at the big picture.
Exactly. Investing is more than just looking at numbers on a spreadsheet.
I feel like we've learned so much about PE ratios today.
Mhm.
We've gone from not even knowing what they are to being able to analyze them and understand what they can tell us about a company.
I think so too.
Hopefully our listeners feeling a lot more confident about using PE ratios to make smarter investment decisions.
Yeah, and to leave everyone with something to think about, what if you find a company with a high PE ratio, but you're really confident in their growth potential and their financials look solid?
Yeah.
Is that a risk you'd be willing to take for the chance to earn bigger returns?
Hmm. That's a good question.
That's the kind of decision that investors face all the
For
time.
another deep dive.
Always ready to go deep.
Awesome. Today we're tackling a question that pops up all the time in equity research interviews.
Oh, yeah, this is a big one.
It is. Basically what we're trying to figure out is how a 0.5% RBI repo rate hike would affect the stock market. That's pretty complicated, right?
It can be, yeah. There are a lot of moving parts, but don't worry, we're going to break it all down.
Perfect. So maybe we should start by defining what the repo rate actually is, just to make sure everyone's on the same page.
Definitely. In the simplest terms, the repo rate is the interest rate that the Reserve Bank of India, the RBI, charges when they lend money to commercial banks.
Okay, that makes sense. So it's like the RBI setting the price for money, right?
Exactly. And when the RBI hikes that rate by, let's say, 0.5%, like in our question, it means borrowing money becomes more expensive for those banks.
Gotcha. So what happens then? Those banks just have to accept the higher rate.
Well, they can try, but what usually happens is they pass that increase on to their customers. So now companies who need loans are also going to face those higher interest rates.
Right, because businesses need loans all the time to operate and grow.
Exactly. And if those loans suddenly become more expensive, it puts a strain on their finances. Think about it like this. You're running a business, you're trying to make a profit, suddenly your loan payments go up. What are you going to do?
You'd probably have to raise prices, right,
Yeah,
to cover those extra costs.
exactly. And when lots of businesses do that at the same time, we start to see this thing called inflation.
Okay, so the RBI raises rates. That makes borrowing pricier. Businesses raise prices, and boom, inflation.
You got it. And inflation is basically a fancy way of saying that the cost of living goes up, everything gets more expensive.
Yeah, I've definitely noticed that at the grocery store lately. Oof.
Exactly. It impacts everyone. And when people are spending more on everyday things, they have less money left over for other stuff like investing.
That's true. If I'm shelling out more for groceries and gas, I'm probably not going to have as much to put into the stock market.
Right. And that reduced investment directly impacts the flow of money into the market. Less money coming in means less buying power, which can affect stock prices.
Wow, okay, so it's like this chain reaction. The RBI hikes the repo rate, borrowing gets expensive, companies raise prices to cover their costs, that leads to inflation, people have less money to invest, and ultimately, the stock market feels the pinch.
You nail it. It's all connected.
But I'm curious, is it always bad news for the stock market? Are there any scenarios where a repo rate hike could actually be beneficial for certain companies or sectors?
That's a great question. And you're right, it's not all doom and gloom. While a rate hike generally means tighter financial conditions, some sectors can actually benefit. Think about banks, for example.
Oh yeah, because banks make money from lending, right?
Exactly. Higher interest rates mean they earn more on those loans.
So it's not a one-size-fits-all situation. Some sectors might struggle while others thrive. It's like a puzzle where each piece reacts differently.
That's a great way to put it. It's all about understanding the bigger picture.
Well, this deep dive has been super insightful. Thanks for breaking it all down. It definitely feels like a crucial topic to understand for anyone interested in finance.
My pleasure. The key is to show that you understand the fundamentals. You can connect the dots and think critically about how these different pieces of the puzzle fit together.
Couldn't have said it better myself. And to all our listeners, keep those insights in mind as you continue your own explorations of the financial world. Ready for another deep dive? Today, we're tackling a financial concept that can be a bit tricky, even for those of you who've been around the block a few times in the investment world.
Yeah, these metrics can definitely be a bit head-scratching at first glance.
Exactly.
Yeah.
We're talking about EBITDA and PE multiples. And specifically, we're going to be looking at, well, what does it really mean when a company has a really high EBITDA, but a kind of low PE multiple? And why should that even matter to you as an investor?
It's a great question, one that I think a lot of people have.
Absolutely, because understanding this dynamic can really help you see through the smoke and mirrors and get a clearer picture of a company's financial health. And that's crucial when it comes to making smart investment choices.
Couldn't agree more.
So let's break it down, starting with the basics. What is EBITDA? Essentially, it's a way to assess the overall value of a company that's the EV part, taking into account not just its stock price, but also things like debt. So it's a more holistic view than just looking at the equity side of
Right.
things.
And then you've got the PE ratio, which is probably more familiar to a lot of people. It's a simple measure of how much investors are willing to pay for each dollar of earnings.
Right, and that's where it gets interesting.
Mm.
Because if you've got a company with a super high of EBITDA, meaning their enterprise value is big compared to their earnings, but their PE ratio is low, it can be a bit of a red flag.
Yeah, and that often comes down to debt. A high of EBITDA coupled with a low PE can signal that a company has a lot of debt on its books. It's like, imagine you're looking at two houses. They both generate the same rental income, but one has a massive mortgage and the other is completely paid off.
Okay, family.
The one with the mortgage would have a higher EBITDA because you're factoring in the total cost of the house, including that debt.
Yeah.
But its PE ratio could be lower because the owner's equity, their actual ownership stake, is smaller due to that big ol' mortgage.
Oh, that's a great analogy. Makes it much easier to visualize. So if I'm seeing this pattern in a company's financials, it's a signal to dig deeper into their debt situation.
Exactly. You want to understand how much debt they have, what kind of debt it is, and most importantly, whether it's manageable given their current earnings and cash flow.
Right, because a certain amount of debt is normal,
Mm.
even healthy, for businesses. I mean, they use it to grow, to invest in new projects. It can be a strategic tool.
Absolutely. Not all debt is created equal. The key is to understand the context. Is the company using debt strategically to fuel growth and create value for shareholders? Or are they drowning in debt and struggling to stay afloat?
Yeah. So as I'm looking at companies and considering investments, it's not as simple as just saying high debt is bad.
Right. There are plenty of industries where carrying a lot of debt is just part of the game. Think about like utilities or real estate. These are capital intensive sectors where you need a ton of money up front to build infrastructure or buy properties. So debt financing is pretty standard in these industries.
Makes sense. So it's really about understanding the company's specific situation, the industry they're in, and whether their debt strategy makes sense in that context.
Precisely. You want to look at their track record. Have they managed their debt well in the past? Do they have a clear plan for using debt to generate returns? These are all crucial questions.
So this EBITDA to PE relationship, it's kind of like a flashing neon sign telling me to put on my detective hat and do some more digging.
Exactly. It's a starting point for a deeper dive into the company's financials.
Now, before we wrap up, I do want to add that debt isn't the only thing that can cause this kind of discrepancy between EBITDA and PE.
Right. Sometimes it's about market perception and expectations about future growth. If a company is seen as having massive potential, maybe they're on the cusp of some game-changing technology, investors might be willing to pay a premium for their stock, even if their current earnings are relatively low.
Ah, that's a great point. So even if a company has a low PE ratio right now, a high EBITDA might indicate that the market sees big things on the horizon.
Exactly. It's all about understanding the nuances and putting all the pieces together to make informed decisions.
Well said. All right, let's jump right in. We're talking finance interviews today. Those things can be a little nerve-wracking,
Definitely.
especially when they hit you with those tricky financial questions.
Yeah, you want to make sure you're ready for anything they throw at you.
Exactly. And one thing that might come up that can really throw people off is the inverse of the PE ratio.
Ah, yes, the good old earnings yield.
The PE ratio, it's something we talk about all the time, but maybe we don't always stop to think about what happens when you flip that ratio.
Yeah, it's interesting, right? It gives you a totally different perspective on a company's performance.
So let's dive into that a little bit today.
Sounds good. Let's break it down.
So we all know the PE ratio. That's price to earnings.
Right. It's a pretty standard metric for valuation.
Yeah, it gives you a quick snapshot of how much investors are willing to pay for each dollar of a company's earnings.
Exactly. But sometimes it can be a little hard to grasp. That's where the inverse comes in.
So what is this inverse? What are we talking about here?
Well, it's called the earnings yield or the EP ratio, and it basically flips the PE ratio.
Okay, so instead of price to earnings, we're looking at earnings to price.
Right. So you're essentially looking at the return you're getting for each dollar you invest in the company based on its earnings.
Oh, that makes sense. So instead of seeing how much you pay per dollar of earnings, you're seeing the earnings you get for each dollar you invest.
Exactly. It's just a different way of looking at the same information, but it can be really powerful.
So how do we actually calculate this earnings yield?
It's pretty simple. You take the company's earnings per share,
Okay.
And you divide it by the stock's current market price.
So earnings per share divided by market price. Got it.
That's all there is to it. And the result you get is a percentage that represents the earnings yield.
Okay, so if a company has an earnings yield of, say, 5%.
That means that for every dollar you invest in the company, you can expect to earn 5 cents in profit based on their current earnings.
Ah, okay. Now that's starting to make a lot more sense. So how can we use this earnings yield to actually evaluate a company?
Well, like you said earlier, it gives you a different perspective. So a higher earnings yield could indicate that a company is potentially undervalued.
Undervalued. Interesting.
Yeah, because you're getting more earnings for your investment.
Right.
It could also suggest that the company has strong earnings growth potential.
Okay, so a high earnings yield might be a good sign. But what about a low earnings yield? What would that tell us?
Well, low earnings yield could mean that the company is overvalued.
Because you're not getting as much bang for your buck.
Exactly. Investors are paying a premium for those earnings. Now, of course, this is just one metric.
Right. It's not the be-all and end-all.
Exactly. You always have to look at the bigger picture.
So what are some other things to consider alongside the earnings yield?
Well, you want to look at things like debt levels. A company with a lot of debt might have a high earnings yield, but it could also be risky.
Makes sense.
You also want to consider industry trends. Some industries naturally have higher or lower earnings yields than others.
Right. Like a rapidly growing tech company might have a lower earnings yield than a more established utility company.
Exactly. And you want to think about overall market conditions, too.
Because a booming market can lift all boats, even those with lower earnings yields.
Right, so you really need to consider all of these factors in conjunction with the earnings yield to get a complete picture of a company's financial health.
So it's not a magic bullet,
No, but it's a valuable tool to have in your arsenal.
especially if you're heading into a finance interview.
Absolutely. Being able to talk about the earnings yield and how it relates to other financial metrics can really impress an interviewer.
Yeah, it shows that you're thinking critically
Mhm.
and that you're not just looking at things at surface level.
Exactly.
So I think we've covered a lot of ground here today.
We've really delved into the earnings yield.
We've talked about what it is, how to calculate it, and how to interpret it.
And most importantly, we've talked about how to use it in conjunction with other information to make informed investment decisions.
And how to really impress those interviewers.
Yes. Now, let me leave you with something to think about.
Okay.
How might understanding this earnings yield change your perspective on investing in general?
That is a great question. I think it could really help people see things from a different angle.
Exactly. It can make you a more informed investor.
You know, one of the questions I see pop up all the time, and I bet you've wondered about this too, is how to really nail that "why do you want to work for us?" question in an interview.
Oh, yeah.
It can be a bit of a minefield, right?
Absolutely.
So today we're going to dive deep into some expert advice on how to handle this question like a pro. We've got some fantastic insights from a piece I found recently that really breaks down not just what to say, but the thinking behind it.
I'm excited to hear this.
Yeah, I think this is going to be really useful. You know, it's easy to just say, "Oh, I admire your company," or something generic, but that's not going to cut it, right?
No, not at all.
This advice goes way deeper. It's about showing that you really get what the company's all about, what their values are, and how your skills and passions actually fit into that bigger picture.
Right. It's about showing that you've done your homework, gone beyond just skimming the website.
Exactly. So let's jump right in. The source we're looking at today actually uses a financial analyst role as an example.
Yep.
But even if you're not in finance, the principles apply across the board, really. It's all about making that connection between you and the company.
Yeah, I think the core of this is demonstrating that you're not just looking for any job. You're looking for this specific job at this specific company.
Right, and this advice really emphasizes that. It even gives an example answer where the candidate talks about their experience and how they go above and beyond. Now, that phrase gets thrown around a lot. So is that really enough? Does it actually resonate with interviewers, or does it just sound like, empty buzzwords?
I think it depends how you use it. Just saying, I go above and beyond without backing it up, yeah, that's just a cliche.
Right.
But if you can give specific examples, real situations from your past where you actually did go the extra mile, that's what brings it to life.
Right. You need that substance behind it.
Absolutely. For example, instead of just saying you improved efficiency, say, I implemented a new system that reduced report generation time by 20%. That's quantifiable, it's concrete, it shows the impact you had.
Yeah. And that's
Yeah.
what stands out, right? If you were on the other side of the table, what would make you really pay attention?
It's the details, for sure. The stories, the specifics that show me this person is not just talking the talk, they're walking the walk.
Yeah. I remember in some interviews feeling this pressure to say all the right things, even if I wasn't sure what the interviewer actually wanted to hear.
I think it's a balance. You do want to use keywords that are relevant to the role in the industry that shows you speak the language.
Yeah.
But genuine enthusiasm and curiosity, that's what makes you memorable. Think about it. Who would you rather work with? Someone who recites a perfectly rehearsed answer? Or someone who's genuinely excited about the work?
Yeah, that makes sense.
Yeah.
So let's put this into practice. Let's say I'm interviewing for a marketing role at a tech startup, something that's really hot right now. How could I use this advice to craft an answer that showcases that passion and curiosity?
Well, you could start by talking about what specifically excites you about this company. Maybe it's their innovative use of AI in marketing.
Yeah, that's a good one.
And then you can connect that to your own experience. Say something like, I'm really fascinated by how your company uses AI to personalize customer experiences. In my previous role, I actually led a campaign using similar technology, and the results were incredible. It really ignited a passion for this kind of work.
Oh, that's really good. You've got the keywords, you've got the experience, and you're showing that genuine interest. But sometimes I think companies have these really vague mission statements.
Yeah.
How do you actually connect with that when it feels a bit, I don't know, generic?
That's where the deeper research comes in. Go beyond the website. Look at employee reviews on sites like Glassdoor, read interviews with company leaders, check out their social media. It's about getting that inside scoop on the company culture.
Yeah, it's about getting that real picture.
You might find they're really passionate about work-life balance, or they encourage continuous learning, or they have a strong commitment to social responsibility. These are the things that will help you see how your own values align with theirs.
I love that. So it's almost like a detective mission, right? You're digging deeper to find those genuine points of connection.
Exactly. And remember, answering this question isn't just about impressing the interviewer. It's also about figuring out if this is the right environment for you.
Right.
It's a two-way street.
I like that a lot. So the next time you're prepping for an interview and you come across that dreaded "why us" question, remember, it's not just about flattery, it's about connection.
Absolutely.
Show them you've done your homework, highlight those shared values, and let your genuine enthusiasm shine through. I think we can wrap it up there for this deep dive.
Yeah, that was a good one.
As always, thanks for joining us. And remember, the best interviews are the ones where you're not just trying to get the job, you're also trying to figure out if it's the right job for you. All right, buckle up, because today we are diving deep into something super practical.
Ooh,
Like-
practical. I like that. What are we tackling?
We're talking about nailing that equity research interview.
Ah, yes, the interview. A necessary evil.
Couldn't agree more. But look, you've gotten your foot in the door, you've got the interview.
You've got to be ready for anything.
Exactly. And one question that always pops up,
Let me guess.
why equity research?
Bingo. Classic.
And our source material today gives us a possible answer, so we're going to break it all down, see what works, what we can add.
Love it. Let's dive in.
Yeah, this question, it seems simple, right?
Yeah.
But it can really make or break you in an interview.
Oh, absolutely. Because it's not just about giving the right answer.
Oh, so what's it about then?
It's about showing them who you are, why you're passionate about this field.
Okay, I like where you're going with this.
Yeah.
Because I was looking at this source material, and it talks about the thrill of the job, which I found interesting.
Oh, I love that. It's like that feeling you get when you're about to crack a code.
Yeah. It even compares it to figuring out a giant math problem.
Because at the end of the day, that's what equity research is, solving a problem.
But with, like, real-world
That's
consequences.
the consequences.
Right, so bringing that excitement, that problem-solving energy to your answer.
It makes you memorable.
Exactly.
It shows them you're not just in it for the paycheck. You genuinely want to uncover those hidden gems in the market.
So let's dig a little deeper into the source's answer. It mentions these factors that influence a company's stock price.
Ah, the nitty-gritty.
Yeah. Can you break that down for us a bit? What are those factors?
All right, so imagine you're an equity research analyst, right?
I'm putting on my detective hat.
Perfect. First, you've got to look at the company itself.
Okay, what does that mean?
You're diving deep into their financial statements.
Oh, yeah. The balance sheet, the cash flow statement, all that jazz.
Exactly. You're looking at their revenue growth, their profitability, how much debt they have, that kind of stuff.
So we're getting a sense of their financial health.
Exactly. Are they a strong company, or are they teetering on the edge?
Right. Makes sense.
But it doesn't end there.
Oh, there's more.
Oh, yeah. Next, you need to understand their industry.
Okay, like Who are their competitors? What trends are impacting their business?
You got it. Is there a new technology that could disrupt the whole game? Are consumer tastes changing? You've got to see the big picture.
Wow. It's way more complex than just looking at a company's website.
Absolutely. Then, zoom out even further, we've got to consider the whole economy.
Ooh, the macro stuff.
Yep, things like interest rates, inflation, currency exchange rates, all these can affect a company's stock price, no matter how great the company might be on its own.
Wow, that is a lot to juggle.
It is, but that's what makes it so exciting.
So taking all of these factors together, how do you actually, predict where a stock is going to go?
Well, you're building a story. Using all these pieces of the puzzle, you're trying to figure out if the market is underestimating or overestimating a company's value.
It's like a giant puzzle.
That's a great way to put it. And that's what the source answer was getting at with that thrill analogy. Being able to see those connections that others might miss, anticipating market movements, that's the heart of equity research.
Okay, so this all makes sense. But I'm also thinking about our listener right now sitting there prepping for their interview.
Oh, yeah, they're probably scribbling notes.
Hopefully they are.
Yeah.
So how do they actually use this information to give a killer answer?
Well, first off, don't just regurgitate what we just said.
Okay, yeah, don't be a robot.
Exactly. What gets you personally fired up about equity research?
Like, what's your unique angle?
Exactly. Are you fascinated by a particular industry? Like, maybe you're all about renewable energy or you think AI is going to change the world.
I'd want to hear about that. Show your passion.
Absolutely. It shows you're not just looking for any job in finance. You've thought specifically about why you want to be in this field.
And that's huge.
Huge. And you know what else interviewers love?
What?
When you've done your research, like really done your research.
So, more than just reading the Wall Street Journal.
Yeah, I'm talking about picking a few companies or sectors that genuinely intrigue you.
Ooh, good idea.
And follow them. Dive into their financials, see how their stock has been performing. Think about what factors are driving those movements.
Because you might get asked about that in the interview.
Oh, definitely. Being able to talk intelligently about specific examples shows you're truly engaged with the market.
This is making me want to go analyze some stocks right now.
Me too.
Okay, so to summarize, nailing the why equity research question is about more than just knowing the facts.
It's about owning your passion.
It's about showing you understand how those factors, the company, the industry, the macro environment, all fit together.
And it's about showing them you can actually apply those skills, those analytical tools, to real-world companies and situations.
So good. I feel like I learned something today.
Me too. Always learning.
And now, to wrap things up, I want to leave you with a little challenge. Think about a recent event in the stock market that really grabbed your attention
Oh, that's good.
and put on your analyst hat.
Yes.
How would you analyze that event from an equity research perspective?
What factors were at play? What might the implications be for different companies or industries?
Those are the kind of questions that will really help you prepare for that interview.
And keep you thinking critically about the market long after you land the job.
So go explore, keep learning, and best of luck out there.
You got this.
Today we're tackling something that tends to cause a little head-scratching, even for those of us who are pretty comfortable with finance. We're going to break down the difference between sell-side and buy-side analysts.
Sounds like a plan.
Yeah, I figured this would be a good one to really unpack. Everyone throws these terms around, but I think it's easy to get a little lost in the jargon. So let's make it crystal clear. I did some digging beforehand, and it looks like you've got some really interesting sources lined up for us.
I do. You really did your homework. Always good to come prepared.
Always. So my first source jumps right into defining a sell-side analyst. Basically, they say these are the folks working at brokerages or firms that handle individual accounts, and their main job is giving investment advice to those clients. Seems pretty straightforward, right?
Sure, on the surface. But, like anything in finance, there's a lot more to it.
Oh, I bet. So what's going on beneath the surface then?
Well, think of sell-side analysts as the ones really in the thick of it, They're digging deep into specific companies, entire industries even, doing tons of research and analysis. They're churning out reports, poring over mountains of data, and ultimately, they're the ones making those calls. Buy, sell, or hold. The recommendations that a lot of investors end up relying on.
Ah, okay, so they're the ones who are really shaping those decisions.
Exactly.
Gotcha. Okay, so that's the sell side. Now, over on the buy side, we have, of course, the buy-side analyst. My notes say these are the people working for, well, the big players. hedge funds, pension funds, all those institutional investors. And one thing that jumped out at me was that they work on a commission basis.
Yeah, that's an important distinction. It kind of gets to the heart of how their role differs from the sell side.
How so?
Well, buy-side analysts are, you could say, more like investigators. They're on the hunt for the absolute best investment opportunities for their particular institution. So they're sifting through a ton of info, conducting their own analysis, and then they're advising their fund managers on where to put that capital, how to make it work. They're the ones managing these giant portfolios, making the decisions that are in line with, what that institution is trying to achieve.
Interesting. So it's less about generating trades and more about strategizing for long-term growth.
You got it.
Okay, so we've got these two groups of analysts, both crucial to how the financial world spins, but with some pretty big differences in how they approach things. And I guess what really stands out to me is how their motivations differ.
Absolutely. That's a key point.
I mean, it's almost like they're playing different games, even though they're on the same field.
Right. So sell-side analysts, they're often motivated by, well, generating that trading volume, attracting clients for their firms. The more the recommendations turn into actual trades, the better it is for their firm's bottom line. Buy-side analysts, on the other hand, they're laser-focused on maximizing the returns for their specific institution. Their whole success hinges on making smart investment choices that really grow those portfolios.
So different goals, different pressures. And that makes me think about something I saw in these sources about potential conflicts of interest. I mean, we've all heard stories about analysts feeling the pressure to give certain companies good ratings, right?
Yeah, for sure. It's a real concern. And it can definitely happen on both sides, though the reasons might not be the same.
Interesting. So how does that play out differently on each side?
Well, on the sell side, analysts might get pressure from the companies they're covering, wanting to keep those relationships sweet. Or even from, say, the investment banking side of their own firm. On the buy side, it's less about external pressure and maybe more about internal politics, wanting to be in sync with their fund manager's overall strategy, things like that.
That makes sense. So no matter where you are, there are always these competing interests to navigate.
Exactly.
So, okay, let's bring it back to our listener for a minute. Knowing all this, how does it help someone who's trying to, make sense of the financial world? What's the takeaway for them?
It all comes down to being a savvy reader, I think. When you come across those research reports or those recommendations, knowing about these different roles, the different motivations, it can really help you read between the lines. Think about the source, their incentives, any potential biases that might be lurking there. It's all about being informed.
That's a fantastic point. It's like you can't take everything at face value, right? You got to dig a little deeper.
Exactly. It actually makes you wonder how these analysts, with their different approaches and all their motivations, how they ultimately shape the entire financial landscape. It's pretty fascinating to think about.
It really is. Food for thought, for sure.
Yeah.
Well, that wraps up our deep dive into the world of sell-side and buy-side analysts. Hopefully you're leaving with a much clearer picture of how they operate, what drives them, and even some of the challenges they face. Keep those brains buzzing, keep exploring the financial world, and we'll catch you on the next dive. Okay, so you want to know how to just crush it in an interview.
Yeah, like who doesn't?
Especially when they start grilling you with those analytical skills questions.
Yeah.
We've got some really cool insights today from an expert source, all about how to really make your answer stand out.
Oh, yeah.
Not just, give the textbook response.
You don't want to blend in.
You don't want to just blend right in.
Yeah, for sure.
So this source suggests, starting with a phrase like, it's been rewarding to conduct research and analysis in my classes and internships. I don't know about you, but that sounds a little
robotic.
Robotic, a little textbooky.
Definitely textbook.
Right. It's like it checks the box. Like, okay, yeah, I've done some analysis, but it doesn't really light any fires.
Right. It doesn't make you memorable.
It doesn't make you memorable.
Yeah.
Yes.
And I think what's really interesting about this source is how it emphasizes showcasing your genuine passion for analysis. It's not just about listing off the tasks you've completed.
Oh, I see.
It's about conveying that you actually enjoy it.
Okay. Yeah, that makes a lot of sense.
Right. Because you want the interviewer to know that this isn't just something you do. It's something you love.
So how would we actually do that, though? How do we...
Weave in specific anecdotes that highlight not just what you did, but how you felt while you were doing it.
Oh, okay. So, instead of just saying, I enjoy numbers.
Yeah.
You could give an example of a time when you were really
Yeah, were you like elbow deep in a spreadsheet and actually enjoying it?
Yeah.
You know? Like
Yeah.
that's what they want to hear.
Yeah, and maybe even like, I'm thinking back to like school projects or even just like personal projects.
Yeah.
Like, maybe you were like fascinated by, analyzing sales figures for a school fundraiser,
Mm-hmm.
something like,
Or maybe you were working on a research project and you had to analyze data to prove or disprove a hypothesis.
yeah,
Like those are the kinds of things that interviewers want to hear.
yeah. It makes you think of, working on this research project, and I was sifting through this mountain of data.
Oh, yeah.
And suddenly I found this like hidden correlation that nobody else had noticed.
Uh-huh.
And it was just this like aha moment, like cracking a code.
Yes.
I was so excited.
That's the energy.
And you can't fake that.
Exact.
Like you really have to be.
And that's what makes you memorable.
Right.
Because they're going to see so many candidates who just give those like textbook answers.
Yeah. And speaking of memorable, we also want to make sure that we're tailoring our answer to the specific role and company.
Absolutely. So important.
Right. So like if we're interviewing for, let's say, a data analyst position at a tech company,
Mm-hmm.
They're probably really interested in like data visualization and
Yeah. Yeah, how you can turn raw data into compelling stories.
yeah.
Yeah, and think about what they do as a company. What are their values? What are they trying to achieve?
Mm-hmm.
And how can you connect your analytical skills to that?
And I think even beyond like the content of the answer just being tailored,
Yeah.
we should be practicing it out loud.
Oh, absolutely. Practice makes perfect.
Because when you're in that interview room and the pressure's on and you've got the spotlight on you, it's easy to get flustered.
Yep, nerves can get the best of us.
So we really want to like make it feel natural and confident. And the more we practice, the more natural it's going to sound.
Exactly. It'll just flow out of you.
So before you head into that interview, I want you to really take a minute and think about what are your unique analytical strengths? What makes you different?
What is it that you bring to the table that no one else does?
Yeah. And that kind of self-awareness is not only going to help you craft a really great answer,
Yeah.
but it's going to boost your confidence.
Right.
And when you walk into that interview room with that confidence,
You're going to shine.
you're going to shine.
Absolutely.
So remember, showcase that passion, tailor your answers, and practice, practice, practice.
Yeah.
Today, we're tackling something that's super relevant if you're even remotely interested in investing.
That's right.
We're talking about stock analysis. We've got some really cool material sent in about two of the biggest approaches out there.
Yeah.
Fundamental analysis
Yeah.
and technical analysis. Now, I know that those terms sound a bit intimidating,
They
right?
can be. They can be.
Something only like financial wizards understand. But honestly, they're not as complex as you might think. We're going to break it all down. By the end of this, you'll know exactly what they mean. And more importantly,
Right.
you'll have a better sense of which one might be like the best fit for you and your, investing goals.
Exact. It's all about finding the right strategy, like, finding the right outfit for your portfolio.
Oh, I love that. Okay, so let's unpack the first suitcase, right? Let's talk fundamental analysis.
Okay, sounds good.
One of the sources you sent in, it had this great quote about fundamental analysis, saying it's all about figuring out a stock's intrinsic or true value, which sounds pretty deep, right?
It is deep. It's about going beyond the surface.
Like we're philosophers all of a sudden.
Right. Yeah. With fundamental analysis, it's not just about looking at the stock price, like what's it doing today. It's about really scrutinizing the company, looking at their financial statements, their business model. How does the business actually work?
Right.
And even like the overall health of the industry that company's in, it's about understanding what that business is really worth, like deep down.
So it's less about trying to like make a quick buck and more about really understanding a company's potential.
Yeah.
Long term. Like you're not just buying a stock, you're buying a piece of that company's future.
Precisely. Imagine, you're thinking about investing in a company that makes electric cars.
Okay, yeah.
A fundamental analyst, they wouldn't just look at like what the stock price is doing at that moment. They'd want to know, okay, is the demand for electric vehicles actually growing?
Makes sense.
Does this particular company have some kind of technological edge, something that sets it apart? They dig into the company's financials, things like the price to earnings ratio,
Okay.
which helps you understand if the stock price is actually fairly valued, like compared to the company's profits,
Right.
they would look at things like the debt to equity ratio.
Debt to equity, okay.
That helps you gauge the company's financial health. It's kind of like checking their credit score, you
Yeah.
know?
Yeah.
It's all about understanding the nuts and bolts of that business.
Okay, yeah, that makes sense. So it's a lot more like in depth than just seeing if a stock is like up or down that
Oh,
day.
absolutely. Much deeper.
Yeah.
And this long-term perspective, focusing on the fundamentals.
Yeah.
This is why fundamental analysis is really popular with investors who are in it for the long haul.
Right, the long game.
Exactly. They're looking for those companies with, strong fundamentals that can kind of weather those market storms,
Mm-hmm.
and hopefully grow steadily over time.
Gotcha. So that's fundamental analysis, getting like under the hood, looking at the engine, so to speak.
Yeah.
Now let's switch gears completely. Let's talk technical analysis.
Okay. Yeah.
This one, instead of diving in all those financial reports,
Yeah.
it's all about the charts and graphs,
Right.
right?
That's right.
It's almost like they're trying to read a stock's like body language.
That's a fantastic analogy.
Right.
Yeah. If fundamental analysis is like reading a company's biography, technical analysis is more like studying their dance moves. How do they move? They're looking for patterns in the stock's price history, the trading volume, all that stuff.
Okay.
They use that to try to predict where the price might go next.
So now I've heard this idea that like patterns actually repeat themselves in the market. Is there any truth to that? Like, why do technical analysts believe this works? Is it just like market voodoo or something?
It's not voodoo, but it is connected to something really powerful, human psychology.
Okay.
You see, fear and greed, optimism, pessimism, all these emotions, they drive our actions in the market.
Yeah.
And those actions, are decisions to buy or sell. They create patterns in those charts.
Intriguing.
Technical analysts believe that they can kind of decode those patterns, like almost like a secret language
Wow.
to try and anticipate what the market might do next.
So our emotions like literally impact stock prices.
They do. Absolutely. Let's say, you're looking at a chart and you see this pattern called a head and shoulders.
Head and shoulders.
It literally looks like, well, a head with two shoulders.
Okay.
And when that pattern shows up, technical analysts often see that as a sign that the price might drop. Like it suggests, a shift from everyone being really optimistic about the stock to everyone being, a little bit more pessimistic.
Oh.
Or, you got things like moving averages.
Right.
Those are lines on a chart that kind of smooth out the price fluctuations, over a certain period of time. It helps you spot trends.
Oh.
So like if the short-term moving average crosses above the long-term moving average, that could be a sign that the price might be about to go up.
Okay, I'm starting to see how these patterns could actually be pretty useful.
Yeah.
But this brings us to the big question, the million-dollar question.
Mm-hmm.
Which approach is better? Fundamental analysis or technical analysis?
Yeah, that's the classic debate.
Right.
The truth is there's no one better way. It really depends. It's like asking, is a hammer or a screwdriver better? Well, it depends what you're trying to do. The material you sent in, it definitely leans towards fundamental analysis, because they're focused on that long-term potential, which makes sense given their investing philosophy, right?
Right.
But for you, it's about what kind of investor are you? What are your goals?
Yeah.
Are you looking to, buy and hold for years and years, maybe ride out some of those ups and downs in the market?
Mm-hmm.
Or are you more into making those shorter term trades, kind of trying to ride those waves, the price fluctuations?
Right.
It's really different.
So it's all about finding like the right tool for the job, kind of like you said at the beginning.
Exactly. And to really help you think this through, chew on this for a bit.
Mm-hmm.
Imagine you could only have one piece of information about a company before investing.
Okay.
You could either see their financial statements, all the numbers and stuff.
Yeah.
Or you could see their price chart, all those squiggly lines. Which would you choose?
Oh, that is a great question. It really makes you think about which approach like speaks to you more.
Right.
Yeah. Great point to end on.
Yeah.
So just to sum it all up, fundamental analysis, it's about diving deep into those company financials, understanding the business inside and out. Technical analysis. That's all about deciphering those market patterns.
Exactly.
Both valid, both useful, but they serve different purposes, just like, different tools in a toolbox.
That's right.
And the key is finding what works best for you and your own investing journey. All right, so today we're diving into something I'm sure everyone listening has gone through at some point,
Oh, yeah,
job interviews.
definitely.
And to be even more specific, we're going to focus on how to really nail those interviews for analyst positions.
Cool.
So we've got some good sources here to help us break down like what it takes to stand out.
Yeah.
Of course, you have to show off your technical skills, right?
Right, yeah.
Like that's a given. But our sources are pointing to this other thing that's uh, almost more important. Like it's almost like a secret weapon.
So what is the secret weapon?
Well, they're saying it's something that most people wouldn't expect.
Okay.
And that's being able to explain all those technical skills in a way that's clear and concise.
Yeah, that makes sense. You could be the best data cruncher out there, but if you can't explain how you got your findings
Right.
to somebody else, it's almost like you don't have that skill.
Like having a superpower you can't use.
Exactly.
So it's not just what you know, it's how you explain it, especially in an interview when you're making a first impression.
For sure.
And our source even gave a sample answer for that question that everyone gets.
Oh, yeah.
What skills can you offer as an analyst?
Right.
And they said, you should focus on three main things: analytical and quantitative skills,
Okay.
problem-solving skills, and this is where it gets interesting,
Mm.
passion for the markets.
Okay, but wouldn't everyone just say that they're passionate?
Right.
How do you make that stand out?
So that's the question.
Yeah.
How do you actually demonstrate that passion in a way that's believable and different?
Yeah, you're right. Just saying I'm passionate is way too vague.
It is.
You got to show them you're passionate by how you talk about your skills.
Okay.
So, for example, when you're talking about your analytical abilities, don't just say, oh, I'm analytical.
Okay.
Tell them about a time when you solved a complex problem.
An example.
Yeah, maybe you noticed something interesting in the market data that nobody else saw and you dug deeper to figure out why.
Yeah.
You went the extra mile.
Exactly. And then, tell them what you did, how you did it, what tools you used, and what the final impact was.
Oh, so you're saying show, don't tell, and connect it back to the markets.
Yeah, exactly.
What about when they ask about quantitative skills?
Yeah, that's another good one.
Any tips for making those answers stand out?
Definitely. So instead of just listing off a bunch of software,
Right.
talk about how you use those tools to get results.
Results.
Yeah, like quantify your impact. So you could say something like, my financial modeling skills in Excel led to a 10% increase in portfolio returns.
I like that.
Or I created an algorithm in Python that found undervalued stocks, which resulted in... You get the idea.
Yeah, for sure. Results are super important. But I've heard that going overboard with the passion thing can backfire.
Oh, yeah. How so?
Some people say it can make you sound naive, especially if you're just starting out.
That's a good point.
What do you think?
It's all about being genuine and not just throwing around buzzwords.
When you talk about your passion, make it personal.
Personal. Okay.
Yeah, so maybe you're really into a specific sector or you've been watching a certain company grow like crazy. Don't just say, I'm passionate about fintech.
Okay.
Say something like, I'm fascinated by how blockchain is changing the way traditional finance works.
Oh, that's much better.
Yeah.
So find that balance between, showing your knowledge, but also letting your real enthusiasm come through.
Exactly, because that spark of authentic enthusiasm, that's what makes you stand out.
Got it.
It tells the interviewer, you're not just looking for any job, you really care about this field.
Okay, that's good advice. Now let's get back to those problem-solving skills.
Okay.
Our source mentioned something called the STAR method.
Oh, yeah, the STAR method.
What is that all about? Can you break it down for our listeners?
It's a great way to structure your answers and make sure you're not forgetting anything.
Okay.
So STAR, it stands for situation, task, action, result.
Okay.
So first, you describe the situation you're in, like what was the problem you had to solve. Then you outline the specific task you had to do, like what was your role in all of this. After that, you explain the actions you took to fix the problem.
Okay.
And finally, you talk about the positive result you achieved.
So it's about telling a complete story.
Exactly.
It's not just about the solution you came up with.
Right.
It's about the whole journey.
It helps the interviewer understand how you think, how you approach challenges, and what you're capable of achieving.
I see. So it's like giving them a peek into your problem-solving process.
Yeah, exactly.
This has been really helpful.
Good. Glad to hear it.
So to sum it all up, when it comes to acing those analyst interviews, clear communication is key.
Definitely.
Don't just tell them about your skills. Show them with real examples and quantifiable results.
Right.
And finally, let your passion shine through, but make it genuine and specific.
For sure.
You want them to see that you're not just spitting out textbook answers,
Yeah.
but that you really understand and care about this field.
Couldn't have said it better myself. And one last thing I'll leave you with, practice talking about your skills and experiences out loud. The more comfortable you are, the more confident you'll sound. And that confidence can make all the difference.
That's great advice. Thanks for breaking it all down for us.
No problem. Happy to help.
To everyone listening out there, good luck with those interviews,
You got this.
and we'll catch you on the next deep dive.
See you then.
All right, so today we are really diving deep. We're going to tackle financial forecasting,
Yeah.
and specifically those DCF projections. We've talked a little about this before, but
Yeah.
it's always interesting because it's basically trying to look into the future of a company's finances, which, as we know,
Yeah.
no one can really do that.
It's a tricky business, right? It's like,
Yeah.
I always kind of think of it as trying to predict the weather.
Oh, yeah.
But instead of, will it rain or will it be sunny,
Yeah.
we're talking about dollars and cents. And so there are all these different factors that come in. But one of the first things I kind of noticed in the material you sent me is that there's this like 5 to 10 year time frame.
Right.
That's like the standard, it seems, for these DCF projections.
Yeah, and that's kind of what struck me, too, when I was looking at the stuff you sent over.
Yeah.
It's like, all right, why
that range?
why that range? Why not shorter? Why not longer?
Yeah.
What's the logic there?
So I think to understand that, we have to kind of unpack a few things. First, like you said, why not shorter? So let's say you only project out like 2 years or something.
Right.
Most companies are evolving and growing, right? I mean, sometimes they're shrinking, but
Right.
hopefully not.
Yeah.
But, they're launching new products. Maybe they're entering new markets. Maybe they're doing some internal restructuring, like streamlining operations or something.
Mm.
A shorter time frame might miss those big pivotal shifts and how those impact future cash flow. You're not really giving those changes enough time to like actually affect things, to actually see the financial impact.
So you need more of a runway, basically.
Yeah, you need a longer runway for those changes to take off, financially speaking.
Okay, so 5 years gives you more of that view.
Right. 5 years at least lets you get a better picture of how these strategies might play out. You get more realistic projections.
Makes sense. But then on the flip side, going beyond 10 years, it seems like that's where it really gets difficult.
Yeah.
Like murky. Yeah, it's super murky. I'm trying to think. It's almost impossible to imagine.
Yeah.
Like what TikTok trends are going to be around in 10 years.
Yeah.
You know?
Exactly.
It's so hard to even fathom. So when you're talking about finances, it's got to be even harder.
Yeah, it's really tough. And it boils down to there's just so many unpredictable variables over that kind of time period.
Right.
I mean, you could have huge market shifts. You could have some new disruptive technology that comes out of nowhere that no one saw coming.
Right.
Major global events that you can't predict.
Like a pandemic. I mean,
Right.
nobody had that on their 2019
Right.
financial forecast.
Exactly. It's like those are the kinds of things that can really throw even the most sophisticated projections completely off course.
Wow. Okay, so that makes sense. But it does raise a question for me. If companies are basing these really big decisions, potentially billion-dollar decisions, on projections that are really only reliable for 5 to 10 years out, what does that say about how we plan for these really long-term challenges? I'm talking about climate change, resource scarcity, things that we know are happening. These are issues that are going to play out over decades, right? Not just a few years.
It's such a crucial point, and I think that's kind of where traditional DCF projections, they sort of fall short. You need different tools, I think, when you're dealing with long-term challenges that are more complex.
So what are some of those tools? What could they use instead?
Well, one that comes to mind that's been getting a lot of attention is scenario planning. So instead of trying to predict the one future, you're kind of planning for different potential futures based on different assumptions about how these challenges might play out.
So almost like a choose your own adventure, but for business.
It's kind of like that. It's acknowledging that there are different possibilities, and you need to think through what each of those means for your business, for your financial health.
So instead of pretending like we can just see the future,
Right.
you're acknowledging there's this inherent uncertainty.
Exactly. I think that's a big part of it.
That's really interesting.
Yeah.
I like that way of looking at it. So it seems like the big takeaway here is that while these projections can be really useful tools, they definitely have their limitations, especially when it comes to these big long-term challenges that we're facing.
Absolutely.
It makes you wonder, are we really equipped to plan for a future that's getting harder and harder to predict? Something to think about, right?
Definitely something to think about.
Well, thanks for joining us for this deep dive. Really appreciate it.
Thanks for having me.
Okay, so have you ever been like totally freaking out before a job interview?
Oh, yeah. I mean, who hasn't, right?
Right. It's like you're trying to, sound all smart and confident, but inside it's just like butterflies.
Mm.
And then they hit you with that question,
Which one?
you know, which industry are you most interested in and why?
Oh, yeah, that's a classic.
So today we're going to deep dive into like how to totally nail that question and like make a killer impression.
Sounds good.
Okay, so we're looking at some advice in an article, um, and they gave the sample answer. I'd like to write about the technology industries, which are the most interesting to me.
Hmm. Yeah.
What do you think? Like, is that a decent starting point?
Yeah, I think it's pretty solid. It's clear, it's concise, it gets straight to the point.
Okay.
But, it's kind of like a recipe. You got the basic ingredients right.
Yeah.
But now we need to, add some spice.
Okay, I'm listening. How do we take it from like solid to whoa,
Yeah.
amazing?
By giving them the why. Like anyone can say tech is interesting, but what about you makes you so into it?
Right?
Maybe you're like totally obsessed with how AI is changing the creative world, or you're all about making tech accessible to everyone.
You're so right. It's like instead of just saying you're interested, you got to show them you're. So, like, for example, if I'm super into sustainability, I wouldn't just say like renewable energy is cool.
Exactly.
I'd be like, I'm really passionate about tackling climate change,
Yeah.
And for me, the renewable energy industry is where I see the biggest potential to make a difference.
Now you're talking. You just connected your own personal values to the industry's goals. It shows you've actually thought about where you fit in and why you care.
And that's way more powerful than just like throwing around buzzwords.
100%.
I get it.
Yeah.
Okay, so let's brainstorm some more examples just to like get those creative juices flowing.
Yeah, love that.
Okay, so what about someone who's like a total data nerd, you know,
Yeah.
loves digging into numbers and uncovering insights?
Oh, totally. They could say something like, I'm drawn to the financial industry because I find it fascinating how, complex data can tell a story and help make strategic decisions.
Ooh, I like that.
Yeah.
Shows they've got the skills
Yeah.
and a real intellectual curiosity.
Hmm.
What about someone who's more like people-focused?
If you're all about building relationships and giving people amazing experiences, you could say something like, the hospitality industry really excites me because I love, creating welcoming environments and exceeding people's expectations.
See how each why is totally unique to the person in the field.
Exactly.
This is making so much sense. It's not about like finding the right answer. It's about finding your answer.
Nailed it. Authenticity is key.
Mhm.
The interviewer is also looking for someone who's, engaged and enthusiastic. If you're genuinely excited about the industry, that's going to come through.
This has been so helpful. Okay, so to our listener out there getting ready for that big interview, remember when they ask about the industry you're interested in, don't just tell them what you like. Tell them why you like it. Make it personal. Make it passionate. Make it yours.
And one last thing to think about as you're prepping, ask yourself this: what unique skills or perspectives can I bring to this industry? That's what's really going to make you stand out from the crowd.
All right. Diving in today, we're tackling the world of investing. Specifically, two totally different approaches, those being growth versus value investing.
Yeah, absolutely.
Our source material, really digs into what makes each one pick and even poses that question, which strategy, really calls to you as an investor, I mean.
Right.
But there's one point that really, I don't know, just jumped out at me, this idea that value investing, they say it's, quote, significantly more adaptable. I'm so curious to hear your take on that.
Yeah, no, it's a really interesting point. I think what stands out to me the most about these two approaches is how they reflect different ways of looking at like how the markets move, right?
Yeah.
And then in turn how you spot those key opportunities.
Uh-huh.
So with growth investing, you're essentially looking for companies that have like massive potential for, really rapid earnings growth.
Right.
Think of it like you're trying to find that hot new tech startup that everybody's saying is going to be, the next big thing.
Okay, so you're riding that wave.
Yeah, exactly.
You're riding that wave of those, high growth, high potential companies.
Exactly.
But then what about value investing? Where's that unique angle there?
Value investing, it's a bit more like, you're digging for treasure, you're trying to unearth those hidden gems that the market has, for whatever reason, just completely overlooked.
Oh, interesting.
So you're looking for stocks that are currently undervalued, right? Like they're priced below what they're actually worth.
Hmm.
And the idea is that, once the market kind of wakes up and realizes, hey, wait a minute, this company is actually really valuable, that's when you see those big returns.
Yeah, that makes sense.
Ah,
Now, you mentioned earlier that our source material, it calls value investing, significantly more adaptable. And that really got me thinking.
right.
What exactly is it about value investing that makes it so, well, adaptable?
Yeah, I think that's a really key insight from the source. The real strength of value investing is in its flexibility. It's
Hmm.
not about like chasing the latest trends or getting caught up in the hype. It's about having this deeper understanding of what something is truly worth, like its intrinsic value.
Hmm. Interesting.
Intrinsic value. And that holds true no matter what's happening in the market. And what's even more interesting is that this principle, it's not just limited to stocks. You can apply it to real estate, to bonds, even when you're evaluating a whole business.
So it's about applying that lens of
Yeah.
intrinsic value to like, a whole bunch of different things.
Yeah, absolutely.
But for our listeners, I mean, how could they actually use this adaptability in their own investment decisions?
It really starts with a shift in mindset. You have to look beyond the surface, beyond all the hype, and really try to understand what an asset is truly worth. So you got to ask yourself, is the market price right now, is that actually a fair reflection of what this thing is worth? If it's not, well, then you might have just stumbled onto one of those hidden gems.
I like that.
Yeah.
Now, thinking about this adaptability, could you maybe give us an example of how a value investor might react differently, let's say, to a market crash compared to someone who's more focused on growth?
Oh, absolutely. Let's say the market, it takes a sudden nosedive, right?
Uh-huh.
A growth investor, they might start to panic. They see their high-flying stocks plummeting and they get worried.
Right, because everything's like tied up in those high growth things.
Exactly, yeah. But a value investor, they see this crash and it's like opportunities knocking. They understand that the market, it has these short-term swings, but those swings don't always reflect the true long-term value of a company.
I see, yeah.
So while everyone else is selling, a value investor is looking to buy. They're trying to scoop up those undervalued assets while they can.
That's a really interesting way to look at it, like seeing opportunity where other people are seeing, complete chaos.
Right, exactly.
But, I do have to wonder, are there times when growth investing, just by its nature, might lead to, like, much bigger returns, especially if you're in a really booming market?
Oh, there's no doubt about that. Growth investing can definitely yield some impressive returns, especially in those bull markets where those high growth companies, they thrive.
Right.
But the flip side is that it can also be way riskier.
Sure.
If those companies don't live up to the hype, those stocks, they can fall just as fast as they rose.
Yeah, it's a much bigger swing.
Exactly.
So it's a trade-off.
It is, yeah.
Yeah.
Value investing, with its emphasis on intrinsic worth, it tends to be a bit more stable, more resilient over those longer time horizons.
This whole conversation, it's got me thinking beyond just investing.
Oh, yeah.
Could you apply this value mindset to other areas of life too?
Oh, absolutely. Think about it like choosing a career path, right? If you've got that growth mindset, you might be drawn to like the hottest job titles, the industries that everyone's talking about. But if you're coming at it from a value perspective, you're going to be more focused on developing skills that are always in demand no matter what the trends are.
That's true, yeah.
Or even something like learning a new language, a growth approach that might lead you to pick like the most popular language, the one everyone's learning,
Right.
but a value approach. You might be drawn to a language that's less common but has real strategic importance, maybe in a specific field or a particular region of the world.
I like that. So to kind of sum it all up, we've got growth investing, which is all about riding that wave of those high-flying, high-growth companies.
Mhm.
And then there's value investing, where you're searching for those undervalued gems, the things with that, long-term potential.
Right.
And the biggest difference that really struck me was just how adaptable that value approach is. It's
Yeah.
like it's got this flexibility built right in.
Exactly. And you know what? Here's something I want you to think about. Beyond the stock market, where else in your life could you maybe benefit from applying those same principles of value investing? What hidden gems, what undervalued opportunities are out there just waiting for you to discover them?
Hmm. That's a great question.
Yeah,
That's something for all of us to consider.
absolutely.
All right. Let's jump right in, shall we? Today's deep dive, we're taking a closer look at a pretty fundamental metric in finance, the price-earnings ratio, or PE ratio, as you'll often hear it.
Yeah, the PE ratio. Definitely one you'll come across a lot in the investing world.
Absolutely. But before we get into the nitty-gritty, let's make sure everyone's on the same page. Can you give us a quick rundown of what the PE ratio actually is and what it tells us?
Sure thing. The PE ratio at its core is basically telling you how much investors are willing to fork over, like for each dollar of a company's earnings.
Okay.
So, you get it by dividing the company's stock price by its earnings per share. And you can think of it kind of like a temperature check on how the market feels about a company's future, its prospects.
So it's looking ahead, not just at the current numbers.
Interesting.
Yeah, exactly. A high PE ratio that often suggests that investors are pretty bullish, optimistic about the company's growth potential, even if, their earnings right now aren't anything to write home about.
Right, right. Makes sense. Like, think of Tesla. They've consistently had a super high PE ratio.
Yeah.
And that reflects this belief that they're going to be like the top dog in the electric vehicle market.
Yeah, they're going to dominate.
Then on the flip side, you got a company, say like a utility provider.
Okay, yeah.
They might have a lower PE ratio because their earnings are seen as more stable, not as much growth potential, but less risky too.
So like a slow and steady kind of thing.
Yeah, exactly.
Gotcha. So low PE, not necessarily a bad thing, just depends what you're looking for.
Exactly. It's all about context.
Okay, that's a great way to put it. We've talked about how the PE ratio can hint at market sentiment and even help us compare companies in the same industry. But are there any other reasons why investors find this ratio so useful?
Oh, for sure. One of the biggest things is just how accessible it is. Like almost any financial website you go to, they're going to have the PE ratios for publicly traded companies. It's right there.
It's so easy to find.
Super easy. And, it's a really quick way to see how companies stack up against each other. Like if you're looking at, say, tech companies and one's got a PE ratio way higher than the others, well, that might be a red flag, Maybe it's overvalued.
Yeah, could be signed to look a little deeper.
Exactly.
So ease of access, quick comparisons, insights into how the market's feeling. Sounds like a pretty powerful tool to have in your arsenal. But I'm sure there are some catches, right? What are some things we need to be careful about when using the PE ratio?
Right. So here's where we got to get a little more nuanced. Probably the biggest thing to remember is that the PE ratio is based on accounting earnings.
Okay.
And those, well, they can be kind of fudged.
Oh, right. Companies can get creative with their accounting.
Exactly. They can, use different accounting practices to kind of make their earnings look rosier than they really are.
Can you give me an example? Like, how could a company do that?
Sure. Think about how companies record their revenue, right? Some companies might be a little aggressive with booking revenue before a product is actually shipped or like fully delivered. So it looks like they're making more money than they really are, at least in the short term. Or they might mess around with how they calculate depreciation, how much value an asset loses over time. And all these things can impact their reported earnings, which then affects the PE ratio.
So basically you're saying the PE ratio isn't always telling the whole story. It's like looking at a photo, you're only seeing one angle.
Exactly. It's just a snapshot. It doesn't factor in a company's future growth potential or the risks they're facing. You could have two companies with the same PE ratio, but one might be on the verge of some game-changing breakthrough while the other is, heading for a brick wall.
Wow. Yeah, that's a really good point. So just because a company has a low PE ratio, it doesn't automatically mean it's a bargain. And on the flip side, a high PE ratio isn't a guarantee that it's going to be a winner. We need to do our homework.
100%. The PE ratio is just one piece of a much bigger puzzle.
Right.
You got to look at other things, too. Like
Yeah.
how much debt does the company have? Who's running the show? What's the management team like? Who are their competitors? What's going on in the overall economy?
Right. And I guess that's where things like industry expertise and really being able to think critically come into play. It's not just about the numbers.
Yeah, that's a really good point. Investing, it's not just a science, it's an art, too. You got to blend those hard numbers, like the PE ratio, with a good, solid, qualitative assessment. Really look under the hood.
So to sum it all up, the PE ratio, it's a useful tool, gives us some clues, but it's not a crystal ball. It's a starting point. It's a jumping off point for deeper research. As you're looking at different companies, think about that PE ratio in the context of their industry, how much they might grow in the future, and what risks they're facing. And remember, folks, no single number is going to tell you the whole story.
Yeah.
Now, Here's something to chew on as you keep learning and exploring the world of investing. How can you use this PE ratio alongside all those other metrics and qualitative analysis we talked about to really make well-informed decisions, decisions you're confident about?
That's a great question to consider.
Absolutely. Ever feel like you're cramming for some kind of final exam when you're getting ready for a job interview?
Yeah.
Especially when they hit you with those questions that just make your head spin.
Oh, yeah.
Like, try wrapping your head around this one. What happens if oil prices suddenly take a nosedive, like, say, 20% down?
Mm-hmm.
How's that going to shake things up in the economy?
Mm-hmm.
Today, we're diving deep into this very question.
Right.
And more importantly, we're going to figure out how to give an answer that'll not just survive the question, but totally impress whoever's grilling you.
Yeah.
And to help us untangle this whole economic web, we've got our expert here who can break down the most complicated systems and make them crystal clear.
Oh, well, you're too kind.
So let's jump right in.
Let's do it.
Our source material is painting this picture where a 20% drop in oil prices, it's not just a single event.
Right.
It's like a domino effect.
Yeah.
Some sectors are going to be high-fiving, others are going to be bracing for impact.
Exactly. Yeah. There are definitely going to be winners and losers if that were to happen.
Right? It's not just a black and white, good or bad situation.
No, absolutely not.
So let's break it down.
Okay.
Starting with, I think, the industries that would probably pop the champagne if oil prices took a tumble.
Yeah, so you think about industries that use oil as like a main ingredient.
Okay.
Think about the car industry, right?
Okay.
Auto manufacturers.
Yeah.
Plastics, right? They rely heavily on oil.
Mm-hmm.
So if the price of oil goes down, their cost of producing all these goods goes down.
Ah, okay. So their profit margins get bigger, or they can lower prices
Exactly.
to be more competitive.
Exactly. So they could potentially, lower prices, stimulate demand, and really come out on top.
Okay, so if you're in an interview and this question gets thrown at you, you're saying that's a good point to bring up.
Absolutely. Absolutely. I think it shows that you're kind of thinking beyond just like oil prices. You're thinking about, how does this actually impact
Real world.
the real world? Yeah.
Okay, but it's not all sunshine and rainbows. Right. Our source material talks about this thing called the oil patch.
Yeah.
What is that exactly?
So the oil patch, it's basically a term we use to describe regions that are, heavily reliant on oil production.
Okay.
So think like Texas, Alberta, Canada, the North Sea regions. These places depend on oil for jobs, for their economy.
It's their lifeblood.
It's their lifeblood, exactly.
So if oil prices tank...
It's not going to be pretty. You could see a lot of job losses in those areas.
Okay, so how do you delicately bring that up in an interview?
Yeah, you want to be mindful, right? You could say something like, while lower oil prices could be great for consumers in some industries, we can't forget about those oil-dependent regions. It's crucial to acknowledge that those areas and the workers there might actually face some tough times.
Right, so it's like you're showing them you're not just thinking about one side of the equation.
Exactly. You're looking at the whole picture.
Yeah.
You're demonstrating that you understand there are going to be ripple effects, and they're not all going to be positive.
Right, you're showing that depth, that nuance.
Exactly.
Exactly. Okay, now let's zoom out even further and talk long-term. What could this price drop mean for the whole economy down the line?
That's where things get really interesting.
Okay.
Because on the one hand, you've got potential job losses in that traditional energy sector, right?
Yeah.
But this could also be like a launching pad
Okay.
for cleaner energy.
Oh, interesting.
Right. Solar, wind, all that.
Right.
Lower oil prices, they might actually push investors to say, hey, let's put our money in these alternatives.
Because they're looking more attractive now.
Exactly. Exactly.
Okay, so it's like a double-edged sword.
It is. It is. It's a really complex situation.
Okay, and for someone trying to nail this interview, what's the takeaway there?
I'd say highlight that potential shift, show you're thinking ahead. You understand that the energy landscape could be totally different in a few years.
It's like you're showing them you're not stuck in the past.
Exactly. You're forward thinking.
Yeah.
You're seeing the bigger picture.
And our outline actually mentions something that's super relevant here.
Okay.
Geopolitics.
Oh, right.
Right? Like how does this oil price roller coaster play into the whole global power game?
That's huge. Oil, it's not just something we use. It's a global commodity.
Right.
It impacts relationships between countries.
Okay.
Think about it. If some of those big oil-producing nations start hurting financially because of low prices,
Okay.
things could get shaky,
Mm-hmm.
politics get unstable,
Right.
alliances could shift.
So it's like the whole world's kind of holding its breath watching those oil prices.
In a way, yeah. You got to remember, economics and global politics, they're like intertwined. You
Yeah.
can't separate them.
Right. It's like this giant web
Yeah.
in tugs on one strand.
You feel it everywhere. Exactly. This has been so insightful, seriously. So for all our listeners out there getting ready for those interviews, what are the big takeaways they should absolutely remember when they get hit with a question like this?
The main thing is show them how you think. Don't just give a one-sided answer.
Mm-hmm.
Talk about the good and the bad, the short term and the long term,
Yeah.
and definitely bring up those geopolitical angles.
Mm-hmm.
It shows you're not just thinking about dollars and cents, you're thinking globally.
So it's really about showing your thought process, not just memorizing some textbook answer.
Exactly. It's about connecting the dots.
Yeah. And here's a final thought for you to chew on. As you're prepping for those interviews, think about how you can use this kind of thinking, this analysis, for other tough questions.
Mm-hmm.
Because that ability to think critically, to see the whole picture, that's going to take you far way beyond any interview room. Keep learning, keep asking those tough questions.
Keep exploring.
Exactly, and never stop diving deep.
Absolute.
And that's our deep dive for today.
Thanks for having me. It's been a pleasure.
Likewise. Yeah.
You know those situations that come up every now and then?
Yeah.
Someone close to you asks you for advice about money.
Oh, yeah,
It can feel awkward, right?
definitely.
Because on one hand, you want to be there for them.
Right.
You want to help them out,
Of course.
but it's their money.
It is.
And the last thing you want to do is give them bad advice.
Exactly.
So today we're going to deep dive into how to handle these situations.
Sounds good.
We've got some great source material to help us navigate this tricky territory.
Awesome.
Let's just jump right in, okay?
Yeah, let's do it.
So picture this. Your sibling calls you up.
Mm-hmm.
They're thinking about selling off some stock.
Mm-hmm.
And naturally, they want your opinion on it.
Yeah, sounds familiar.
So what do you say?
Well, it's tempting to just give them a straight answer, right? Like,
Right.
hold on to it or sell now before it's too late.
Yeah, you want to be helpful.
Exactly, but that's where things get tricky.
Exactly.
Because what if you're wrong?
Ugh, I don't even want to think about it.
Right, nobody wants to be responsible for someone else's financial losses,
Especially a family member.
especially a family member.
So our source material actually suggests a different approach.
Okay, I'm interested.
It's all about encouraging your sibling to make their own decision.
Interesting.
Instead of giving them a direct answer like buy or sell,
Yeah.
you guide them towards making an informed choice.
I see. So it's about empowerment rather than instruction.
Exactly.
Okay. So how do we do that?
Well, one way is to ask them questions that help them clarify their goals.
Okay, that makes sense.
You could say something like, hey, why are you thinking about selling this stock in the first place?
Right. Get to the root of their motivation.
Exactly. And then you could dig a little deeper,
Okay.
ask about their understanding of the stock's performance.
So you could ask, what do you see as the long-term potential of this stock?
Yeah, exactly. And that gets them thinking about the bigger picture.
I like that.
You're not telling them what to do, but you're helping them analyze the situation themselves.
It's like teaching them to fish instead of just giving them a fish.
I love that analogy.
It's a classic for a reason.
It really is.
So by asking these kinds of questions, you're shifting the conversation away from giving concrete advice
Exactly.
and towards helping them make their own informed decision.
And that's really important because it also helps protect you.
How so?
Well, you're not putting yourself in a position where you could be blamed if things go south.
That's true.
You're simply acting as a sounding board.
A guide on the side rather than a sage on the stage.
I like that. It's a delicate balance, though, right?
Absolutely, you want to be supportive,
Of course.
but also respectful of their autonomy.
Definitely. And that's where things can get a little tricky.
Yeah, because it's easy to slip into that advice-giving mode.
It is,
No.
especially when it's someone you care about.
Exactly, but the key is to remember that ultimately it's their decision.
And their money.
And their money.
So this has been really enlightening.
It has.
I know I've learned a lot today,
Me too.
and I hope our listeners have too.
I hope so.
So before we wrap things up, I
Sure.
want to leave you with one final thought.
Okay.
If you were the one asking for financial advice,
Yeah,
what kind of information would really help you feel confident in your decision?
that's a great question.
Would you want to read financial news? Or maybe talk to a financial advisor? Or just get a different perspective on the situation?
It's really about finding what works best for you.
Absolutely. Because at the end of the day, it's your money and your future.
Well said.
Okay, so today we're going deep on PE ratios. Like that number that everyone seems to throw around when they talk about stocks. We've got a whole stack of research here, articles, analyst notes, the whole shebang.
Yeah, it's a pretty important metric. You really can't avoid it if you're trying to understand how the market values companies.
Right, and that's exactly what we're going to do today. Like, what's the real story a high PE ratio is telling us? What are investors really thinking when they're willing to pay a premium for a company's earnings?
Yeah, and to start, just to level set, maybe we should give a quick definition of what a PE ratio even is.
Oh, yeah, good point. So the PE ratio is basically the price of a company's stock divided by its earnings per share, right? It's
Yeah.
like how much are investors willing to shell out for just $1 of the company's profit?
Exactly. And it's important to remember, like, context is everything. You really want to be comparing PE ratios within the same sector. So, like, comparing a tech company to another tech company or a utility to another utility.
Right, apples to apples, because like you wouldn't compare, I don't know, a high growth tech startup to um, a well-established power company, right? Their PE ratios are going to be totally different just based on the nature of their businesses.
Exactly. So let's say, we are looking at two software companies, right? One has a PE of, let's say, 30. The other has a PE of 15. Does that automatically mean the first company is the better investment? Like, just because that number is bigger?
Hmm. Well, I mean, it sounds like it should be, right? But from the research you sent over, it seems like there's a lot more to this story, right?
Oh, yeah, for sure. A high PE, a lot of times it really just signals high expectations, right? It's not just about where the company is right now, it's where investors think it's going in the future. They're essentially betting on the company with the PE of 30 to grow its earnings at a faster rate than the one with the PE of 15.
So it's not just about like today's profits, it's about tomorrow's potential, right?
Right. Yeah. Think about it. Like, if you're looking at two athletes, right? One's got championships. The other is like a rookie with a ton of potential, but hasn't really proven themselves yet. Investors might be willing to pay a premium for that potential, even if, the rookie hasn't racked up those big wins just yet.
Okay, that makes sense. But some of these articles also talked about this thing called market sentiment. Is that just like investor hype? Could that also be a factor in a high PE ratio?
Oh, absolutely. I mean, sometimes enthusiasm for a stock can push the price up, and that, naturally pushes the PE ratio up as well, even if the earnings don't quite justify it yet.
So it's kind of like, sometimes hype outweighs the fundamentals, at least in the
Kinda.
short term, right? It's almost like the stock market equivalent of a viral TikTok trend or something.
Yeah, that's a good analogy. And it's why you have to be careful with high PE ratios, because sometimes they're a sign of overvaluation.
Right, so a high PE isn't always a good thing.
hmm
And I guess on the flip side, a low PE could be a signal that a company is like a hidden gem that the market's overlooking.
Exactly. It could mean that, yeah, or it could mean there's some underlying issue that's making investors hesitant.
So how do we figure out if a low PE is a bargain or a red flag? Like one of the research reports here mentioned, it could be a sign that the company's undervalued or maybe there are bigger problems going on.
Right. I mean, a low PE could be a great buying opportunity. Like
Yeah.
maybe investors aren't recognizing the true value of the company, but you got to do your due diligence. Look at the financials, see if the company is facing like increased competition or maybe declining sales or even just issues with their management team.
So it's kind of like, don't just jump in because the price seems low. Got to figure out why it's low.
Yeah, I mean, think of it like this. You see a car on sale for a ridiculously low price. You're going to want to know why, right? Maybe it's a steal, or maybe there's a major engine problem. PE ratios are kind of like that.
Okay, so it sounds like PE ratios are more like a starting point, like a clue that tells you to dig a little deeper and do some more research, right? It's not the whole story.
Yeah, exactly. It's just one piece of the puzzle. It can be super useful,
Yeah.
but you can't just rely on it alone. It's all about understanding the context.
Right. So don't just chase the highest PE ratio and think you're going to get rich quick.
Yeah, that's a good way to get burned. Focus on understanding the why behind the valuation. What's driving that number? Is it hype or is it something more substantial?
All right. So that's a great takeaway. PE ratios, valuable, but don't get blinded by the number. Thanks for helping us break it all down.
Anytime.
All right. So you ready to take a deep dive into the world of finance with me today?
Oh, absolutely. Always ready to geek out about numbers.
Okay, good. Me too.
Yeah.
So today we're tackling the price earnings ratio. the PE ratio.
Ah, yes, a classic.
A classic, but sometimes a little bit misunderstood, I think.
Oh, for sure.
So, we always talk about, how to impress in an interview, how to stand out.
Right.
And in the world of finance, dropping some key E ratio knowledge can be a real game changer.
It can really set you apart, you know?
It can because it shows you can, think critically, analyze a company beyond just the surface level.
Right. Not just what's the stock price today.
Exactly.
Exactly.
There's so much more to it.
So let's start with the basics. For our listener who maybe isn't as familiar, what exactly is a PE ratio and what does it tell us about a company?
Okay, so in the simplest terms, the PE ratio is the price of a company's stock divided by its earnings per share.
So it's basically telling you how much investors are willing to pay for each dollar of profit the company is making.
Okay, so it's kind of like a measure of how much faith the market has in a company's future earnings potential, right?
Exactly. That's a great way to put it. A high PE ratio usually suggests that investors are optimistic about the company's growth prospects and they're willing to pay a premium for its stock.
Okay, so that makes sense. But the source material for today's deep dives, it poses this really interesting question, and it's one that I've heard come up in interviews too. What could it mean if a company has a lower PE ratio than others in the same industry?
Yeah, that's a good one. And it's a bit of a head scratcher, right? Because on the surface, you might think, oh, hey, the stock is cheaper, it's a bargain.
Right, right. Like, why wouldn't you want to snap that up?
But it's not always that straightforward, and that's where that deeper analysis comes in. Because a low PE ratio can be a sign of a few different things, some good, some potentially not so good.
Okay, so it's like a clue that we need to start investigating further. What are some of those red flags, or I guess green flags too, that we might uncover when we start digging into a company with a low PE ratio?
Well, the first thing that comes to mind for me is debt. Companies with a lot of debt tend to have lower PE ratios.
Oh, interesting. Why is that?
Well, think about it from an investor's perspective. If a company is carrying a ton of debt, it means they have these big financial obligations, right? Interest payments, principal repayments, and all of that eats into their profits.
Right. Less money for shareholders.
Exactly. And that makes investors nervous for a couple of reasons. One, there's always this concern that the company might not be able to handle those debt payments, especially if interest rates go up or, if their earnings take a hit for some reason.
Yeah, that makes sense. It's risky.
It is. It's risky. And then the other thing is, when a company is heavily in debt, it can limit their flexibility to invest in future growth.
Oh, right. So they can't innovate as easily.
They can't. Or, even just weather a downturn in the economy. They're kind of handcuffed by that debt burden.
Makes sense. So debt is definitely a big factor to consider. But let's say we're looking at a company and their debt levels seem pretty manageable. What else could be pushing that PE ratio down?
Well, another possibility is that they're losing market share. So if a company is seeing its slice of the pie shrink, investors might not be as willing to pay a premium for their stock.
Because it's kind of like betting on a horse that's falling behind in the race, right?
Exactly. You start to question whether they're going to be able to catch up.
And the source material mentions a few examples of this playing out in the real world,
Right.
like BlackBerry and Nokia.
Yeah. Classic examples. They were once these giants in the mobile phone market, but then they failed to keep pace with the whole smartphone revolution, and their PEs, they just plummeted as their market share evaporated.
So it really shows how a PE ratio is reflecting those expectations about the future.
It is. It's all about expectations.
Okay, so we've got debt, we've got market share. What about profit margins? The source material mentions that too, as something to look at with a low PE ratio.
Profit margins are key. I mean, they're telling you how much profit a company is actually making on every dollar of sales. So if those margins are shrinking, it could be a sign that the company's becoming less efficient.
Yeah, okay.
Maybe their costs are rising faster than their revenue, or they're facing really tough competition. And, that can make investors worried.
Yeah, because it makes you wonder if they can actually turn that revenue into sustainable profit.
Exactly. And that's what investors care about ultimately, the bottom line.
Right. And speaking of things that can worry investors, the source material also mentions governance issues.
Oh, yeah, that's a big one.
Can you talk a little bit about how problems within a company's management can impact the PE ratio?
So, things like scandals or unethical behavior or just poor leadership. These things can really damage investor confidence.
Right, because it raises questions about the company's long-term stability.
Yeah.
So what are some red flags that we should be looking for in terms of governance?
Well, I would say things like frequent changes in top management.
Mm.
That can be a signal. Or a lack of independence on the board of directors. You want a board that's going to challenge management and hold them accountable.
Makes sense.
And of course, any history of regulatory violations or legal issues, that's always a concern.
Okay, so we've walked through some key reasons why a company might have a lower PE ratio. We've got debt, market share, profit margins, and governance. But how do we tie all of this together for a listener who's, maybe prepping for a big finance interview? How can they use this knowledge to really knock it out of the park?
Okay, so here's the thing. If an interviewer throws you a question about a company with a low PE ratio, don't just give them a list of potential explanations.
Right.
Anybody can do that. You got to show them that you can actually think critically and apply this knowledge.
Okay.
So you acknowledge that a low PE doesn't automatically mean it's a bad investment, but it does mean we need to investigate further. And then walk them through your thought process. Out of those factors we discussed, which ones seem most relevant in this particular case? Is it a debt issue? Is it market share? Profit margins? Governance? And then the most important thing, what specific questions would you ask to dig deeper and get a clearer picture of what's really going on?
So it's about going beyond just repeating facts and demonstrating that you can use those facts to analyze a situation and really think strategically.
Exactly.
That's how you stand out.
That's how you impress them.
And for our listeners, as you're researching companies and thinking about these different factors, here's a final thought to consider. Imagine you come across a company with a low PE ratio, and it operates in an industry that's undergoing rapid transformation.
Oh, interesting.
How does that change your assessment? Does it make that low PE more concerning? Less concerning? What other questions would you want to explore? Keep those mental gears turning. We'll see you next time for another deep dive.
Sounds good. Always ready to explore.
Awesome. Well, today we're taking a look at sensitivity analysis in Excel.
Ooh, sounds exciting.
Yeah, I know spreadsheets might not sound like the most thrilling topic, but trust me,
Yeah.
this is about way more than just rows and columns.
It's about understanding risk. Right.
Exactly. It's about seeing how different factors, like changes in growth rates or costs, can impact your outcomes.
So, how vulnerable is your business plan to those kinds of changes?
You got it. Our source material starts off by emphasizing something called base case assumptions.
Ah, yes, those are super important.
They are. But for anyone who's not familiar, could you maybe break down what those are?
Sure. So basically, your base case assumptions are your starting point. It's your best guess about how things will play out. Like if you're valuing a company, you might make assumptions about its future growth rate
Right.
or its cost of capital, things like that.
Okay. That makes sense. But we all know that things don't always go according to plan. So how does sensitivity analysis help us account for that uncertainty?
Well, it lets us play around with those base case assumptions and see what happens. What if the growth rate is actually lower than we projected?
Yeah.
What if interest rates go up and that affects the cost of capital? Sensitivity analysis helps us model those what-if scenarios and understand the potential range of outcomes.
So instead of just relying on a single number, we get a much clearer picture of the risks and opportunities.
Exactly.
Now, the source material also mentioned sensitivity tables. What are those, and how do they fit into all of this?
So sensitivity tables are like visual summaries. Imagine a table where you have different assumptions listed in one column,
Okay.
and then in the other columns, you see how the outcome changes based on those different assumptions.
So I could see at a glance, like how much the company valuation would change
Right.
if the growth rate was 5% versus 10% versus 15%.
Exactly. It makes it really easy to compare different scenarios and see which variables have the biggest impact.
That's super useful. And I think our source also highlights how important sensitivity analysis is for understanding the influence of WACC.
Weighted average cost of capital.
Yeah, exactly.
Yeah.
Why is that so important?
Well, the WACC is basically the average rate a company expects to pay to finance its assets. And it has a huge influence on things like stock prices and investment decisions.
Right.
Even small changes in WACC can have a big impact on valuation.
This is making me think back to a project I worked on a while ago. We were deciding whether to invest in new equipment, and at first glance it seemed like a no-brainer.
Really?
Yeah, but then I did a super basic sensitivity analysis, just tweaking a few assumptions about costs and revenue. And it totally changed our perspective. What we thought was a safe bet actually turned out to be much riskier than we initially realized.
Wow, that's a perfect example of how powerful sensitivity analysis can be.
Right.
It really forces you to challenge your assumptions and make sure you're not overlooking any potential pitfalls.
Totally. It's like sensitivity analysis doesn't just give you the answers.
Yeah.
It helps you ask better questions.
Absolutely. And that leads to a really interesting question for our listeners. What other areas of your work or life could benefit from this kind of what if thinking? We've talked about business decisions, but what about personal finance? Or even major life decisions like buying a house or choosing a career path?
That's such a great point. I think there's so much potential to apply these tools beyond the world of business.
Definitely.
Today, we're going to try to unlock the secrets hidden in company financials.
Yeah, we're talking about ratios, those key numbers that can tell you so much about a company's performance.
I'm ready to become a financial detective. We've got a ton of notes here on all the major ratios used in business analysis. I'm talking quick ratio, debt to equity ratio, working capital.
Oh, we've got a lot more than that.
Yeah.
Earnings per share, return on equity, profit margin.
Oh, yeah, right. The price to earnings ratio, too.
It's like a whole alphabet soup of financial jargon.
It really is. Where do we even begin with all this?
Well, think of it this way. Each of these ratios is designed to tell us something specific about a company.
Okay, so it's like each one is a clue.
Yeah, exactly. And when you put all those clues together, you get a much clearer picture of the company's overall health.
So where should we start?
Well, how about with liquidity? That's a company's ability to pay its short-term debts. Keep the lights on.
Right. Keep the lights on.
And one of the key ratios for measuring liquidity is the quick ratio.
Okay, the quick ratio. What does that tell us exactly?
The quick ratio measures a company's most liquid assets. So that's things like cash and marketable securities.
Things they can quickly turn into cash.
Exactly. And it compares those assets to the company's short-term liabilities.
So basically, it tells you how easily a company can cover its immediate bills.
Exactly. A healthy quick ratio is usually considered to be above 1. That means they've got enough quick cash to cover those short-term obligations.
So let me ask you this. What if a company has a quick ratio of, let's say, zero point 0.5? Is that a problem?
Well, it could be. It might mean they're having a little trouble keeping up with their short-term debts.
Oh, so that's definitely a red flag then.
It could be, but it's important to remember context is key, right? Some industries just naturally operate with lower liquidity.
Right. So a grocery store chain might have a very different quick ratio than, say, a software company.
Exactly. You always want to consider the industry and the specific circumstances.
Got it. So quick ratio check. What about the debt to equity ratio? That one sounds pretty self-explanatory, right?
It does, doesn't it? It basically tells you how much debt a company is using to finance its assets compared to the equity they have from investors.
So a higher debt to equity ratio means they're relying more on borrowed money.
Right. And that can be risky.
Sure, if they can't pay it back.
Exactly.
Right.
But it can also be a sign of aggressive growth. If they're using that debt to expand their operations and invest in new projects, that could be a good thing in the long run.
So it's not always bad to have a high debt to equity ratio.
Not necessarily. It all depends on the company's overall financial health and their ability to manage that debt effectively.
Makes sense. All right, let's shift gears a bit. What about profitability? We've got notes here on profit margin and return on equity.
Yeah, those are big ones. The profit margin tells you how much profit a company makes for every dollar of sales. It's a simple calculation. You just divide the company's net income by its revenue.
Okay, so if a company has a profit margin of 10%, that means they keep 10 cents of profit for every dollar of sales.
Exactly. The higher the profit margin, the more efficiently they're generating profits.
So is a higher profit margin always better?
Well, generally speaking, yes. But again, you have to consider the industry. A company selling luxury goods is likely to have a much higher profit margin than, say, a discount retailer, even if the discount retailer is selling way more products.
Right, that makes sense. What about return on equity, or ROE? What does that tell us?
ROE looks at how effectively a company is using the money invested by its shareholders to generate profit. It's like a report card for the management team, showing how well they're using those investments to grow the business.
So if I'm thinking about investing in a company, ROE would be a key ratio to look at.
Absolutely, because it gives you an idea of how much return you can expect on your investment.
Got it. We've covered a lot of ground here, but there's still a few more ratios on our list. What about the price to earnings ratio, or the PE ratio, as everyone calls it?
Yeah, the PE ratio compares a company's stock price to its earnings per share.
So it essentially tells you how much investors are willing to pay for each dollar of the company's earnings.
Exactly. A high PE ratio could mean investors are really optimistic about the company's future growth potential.
Ah, so they're willing to pay a premium for those shares.
Right. But it could also mean that the stock is overvalued. A low PE ratio might suggest the opposite, that the company is undervalued.
Interesting. It's amazing how much you can learn about a company just by looking at these ratios.
It really is. And the beauty of it is you don't need a PhD in finance to understand them.
True. I have to admit, though, I still get a little intimidated by financial statements. Where do I even find all this information?
It's actually easier than you might think. You can find most of it in a company's annual report.
Oh, okay. Those are usually available online, right?
Yes, usually on the company's website. And you can also find a lot of this information on financial websites like Yahoo Finance or Google Finance.
That's good to know. Okay, let's do a quick recap. We've got liquidity ratios like the quick ratio, leverage ratios like the debt-to-equity ratio,
We talked about profitability ratios like the profit margin and ROE.
and of course, valuation ratios like the PE ratio.
Oh, and we can't forget about earnings per share, or EPS. That one tells you how much profit a company makes for each outstanding share of its stock.
Right, EPS. It's a good way to gauge a company's profitability and see how it compares to other companies in its industry.
Exactly. You want to see that EPS is growing over time. That's a good sign.
So we've covered a lot of ground today. It's really amazing how much insight you can gain from these ratios.
It's like having a financial X-ray vision.
Uh-huh. That's a good way to put it. But before we wrap up, any final words of wisdom for our listeners who are starting to feel like financial detectives?
Absolutely. Just remember that ratios are powerful tools, but they're only one part of the story. You always want to consider the bigger picture. Look at the company's industry, their management team, their competitive landscape.
And the overall economic climate.
Exactly. Do your research, think critically, and don't be afraid to ask questions.
Couldn't have said it better myself. All right. Ready to take your stock analysis skills to the next level?
I hope so. We're going deep on valuation ratios today.
That's right. These ratios are like having X-ray vision for a company's financials. We'll be using some insights from a recent research report to guide us. You ready?
Absolutely. Let's get into it.
Okay, so we all know a company's stock price, right? But that only tells us what the market thinks right now.
Yeah, exactly.
What we really want to know is if that price is a good deal. And that's where valuation ratios come in. They let us compare a company's value relative to things like earnings, sales, or assets.
Right. They give us a much better picture of whether that stock price is a bargain, a ripoff, or maybe somewhere in between.
Exactly. So our source outlines 5 key ratios we want to focus on. Enterprise value, or EV to EBIT, EV to sales, EV to EBIT, price to earnings, and price to book value. Let's start with EBITDA. What's the deal with that one?
Okay, so think of EBITDA as kind of like checking a company's financial engine.
Hmm.
It compares the company's total value, including debt, to its earnings. But, and this is important, it's earnings before things like interest, taxes, depreciation, and amortization.
Okay, so you're really getting down to the nitty-gritty of how much profit they're generating from their core operations.
Exactly. You're seeing how efficiently they make money.
So would a higher EBITDA be a good thing then? Like the higher the ratio, the better the engine, right?
Well, not always. You have to be careful there. A high EBITDA, sure, it could be a sign of a really healthy company, but it could also mean the company is actually overvalued.
Ah, I see.
And especially when you compare it to other companies in the same industry.
So it's all relative.
It is. Think of it like this. You're shopping for a car, right?
Yeah.
A car with a flashy paint job and all the bells and whistles might have a high price tag.
Right. Makes sense.
But if the engine's the same as a less expensive model, are you really getting a better deal? You got to look under the hood.
I got it. A shiny EBITDA isn't necessarily a green light to buy. So what about EV sales? How does that ratio factor into things?
Well, EV sales, that one's really useful when you're looking at companies that aren't actually profitable yet.
Ah, okay. Like startups or...
Yeah, exactly. Like high growth startups. It basically tells you how much investors are willing to pay for each dollar of sales the company makes.
I see. So a higher EV sales ratio could mean investors are really excited about the company's growth potential.
But there's always a but, right?
Right. Uh-huh.
It could also be a sign that there's just a lot of hype around the company, inflating the price.
So it's kind of like gauging the buzz around a new band, right? A lot of buzz could mean they're the next big thing, or it could just be a passing fad. How do we know the difference?
Honestly, that's where it gets a little tricky. You got to look beyond the ratio itself and really dig into the company's fundamentals. Look at what's happening in their industry, how strong their competition is. That's how you figure out if the hype is justified.
Okay, that makes sense. So we've got EBITDA, EV sales.
Hmm?
What about EV/EBIT? You mentioned that one earlier.
Right. So EBIT, it's similar to EBITDA, but with one key difference. It adds back depreciation and amortization to the earnings.
Okay, why is that important?
Well, it makes this ratio especially helpful when you're analyzing companies and industries with lots of physical assets. Things like property, plants, and equipment.
Got it. So manufacturing, maybe?
Yeah, manufacturing is a good example. Okay, so we've talked about those three EV ratios. Now let's move on to a real classic, the price to earnings ratio, or PE ratio.
Ah, yes, the PE ratio. I feel like I hear that one all the time. But to be honest, I'm not always sure what to make of it.
I hear you. It can be a little confusing, but it's actually pretty straightforward. The PE ratio tells us how much investors are willing to pay for every dollar of a company's earnings.
Okay, so in theory, a lower PE ratio would be better, right? You're paying less for more earnings.
In theory, yes. And sometimes a low PE ratio does mean you found a hidden gem, a stock that's genuinely undervalued by the market. But, and this is a big but,
Here we go again.
sometimes a low PE ratio is actually a warning sign. It could mean the company has some underlying problems that investors are worried about. Maybe their growth is slowing down, or they're in an industry that's out of favor. Whatever the reason, it means you need to do your homework before you jump in just because the PE ratio looks tempting.
So it's like finding a designer handbag at a crazy low price.
Yeah.
Okay? It could be a steal, but it could also be a fake.
Exactly. You got to do your research. All right, ready for our last ratio.
Absolutely. Bring it on.
Okay, this one is price to book value, or PBV. It compares a company's market value, meaning its stock price, to its book value.
And book value, that's basically the company's net worth, right?
Mhm.
What it would be worth if it sold off all its assets and paid off all its debts.
Yep, that's it. Now, a low PBV ratio can suggest the company is undervalued. The market might not be fully appreciating the value of its assets.
So it's kind of like going to an antique store and finding a beautiful, valuable piece of furniture that's priced way below what it's actually worth.
You got it. But again, and I can't stress this enough, no single ratio tells the whole story. It's like trying to solve a mystery with just one clue.
You need to look at the bigger picture.
Absolutely. You got to consider things like the management team, the competitive landscape, what's happening in the overall economy, all of that alongside these ratios.
Okay, so it's about combining these financial clues with a broader understanding of the company's overall story.
That's it. That's the key.
Wow, you've given us a lot to think about. A whole toolkit for dissecting financial statements.
My pleasure. And now that you have this toolkit, I want you to think about how you would weigh these different ratios.
Good point.
It all depends on your investment goals and how much risk you're comfortable with, right?
Yeah.
That's where the real art of valuation comes in.
Yeah, it's not just about crunching the numbers. It's about using those numbers to make smart decisions.
Exactly.
Awesome. Playing something that might sound a little intimidating at first, valuation multiples.
Yeah, these can be a little tricky.
They can. Especially because our source material today looks like it came straight out of a finance job interview, and a pretty intense one at that.
Oh, yeah, definitely. High stakes for sure.
So the question in the source material is, explain me which are the most common multiples we use in valuation. Kind of blunt, right?
Straight to the point, no messing around. That's a lot of pressure in an interview. You really got to know your stuff.
Yeah, big time. But, instead of freaking out about how tough that interview would be,
Yeah,
I think it'd be fun to walk through how someone could knock that answer out of the park.
totally. Let's do it.
First things first, though. Before we even get to listing out multiples, what are valuation multiples even all about? Like, how would you explain that to someone who, maybe isn't a financial whiz?
Okay. Well, imagine you're trying to figure out if a house is a good deal. You wouldn't just look at the sticker price, right?
Oh, for sure not.
No. You'd compare it to other houses in the area. Maybe look at the price per square foot. That gives you a better sense of its value.
Makes sense.
Valuation multiples are kind of similar. They help us compare the value of different companies, relative to their earnings, sales, or assets. It lets us compare apples to oranges, even if those companies are totally different sizes.
Okay, so like a small startup versus like a giant corporation.
Exactly.
Got it. So in that pressure cooker interview, starting with that kind of explanation, the why behind multiples would be smart.
Definitely. Got to show them you understand the bigger picture.
Right. But then,
Yeah.
of course, they're going to want to know the specifics, the actual multiples. And our source material gives us a whole list to work with.
Yeah, we got a good mix there.
We do, and a bunch of them start with EV. So what's that all about?
EV stands for enterprise value. Think of it like the total value of a company, including any debt it has. So when you see multiples like EV sales, EBITDA, or EBIT, they're all comparing that enterprise value to different measures of how the company's actually doing.
Okay, so let's break those down one by one. EV sales seems pretty straightforward, like how much value a company generates for every dollar of sales, right?
Yeah, pretty much. It's a good basic measure.
But then we get into EBITDA and EBIT, which always make my eyes glaze over a little.
Yeah, those acronyms can be a mouthful, but really it's all about understanding a company's core profitability. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Okay, so what does that actually tell us?
Well, it basically gives you a sense of how much cash the business is generating just from its operations, before you factor in all those other financial things. EBIT is similar, but it strips out the DA, the depreciation and amortization.
Interesting. So in an interview, could you use these EV multiples to compare companies in the same industry? For example, saying company A has a higher EBITDA than company B, so maybe they're more efficient.
Absolutely. That's the kind of insight that would really impress an interviewer. But you always want to emphasize that these multiples are most useful when you're comparing companies in the same industry. Comparing a tech startup's EV sales to a big manufacturing company's wouldn't tell you much.
Gotcha. Makes sense. Now let's move away from EV for a minute. What about the PE ratio? I feel like I hear that one all the time.
Oh yeah, the PE ratio, it's a classic. It's short for price to earnings ratio, and it tells you how much investors are willing to pay for each dollar of a company's earnings.
Okay, so a high PE ratio, that means investors are feeling optimistic.
Could be. A high PE ratio might mean investors have high hopes for future growth, while a low one might mean the company is considered undervalued.
Okay, so in that interview scenario, I could maybe say something like, a high PE ratio doesn't always mean a company's overpriced, right?
Yeah,
It could just mean people expect big things in the future.
exactly. Showing you understand that nuance would definitely score points. It proves you can apply the concept, not just define it.
Right. And speaking of nuance, isn't there another ratio that kind of builds on the PE ratio? The PEG ratio.
Oh, you're totally right. The PEG ratio, that's the price to earnings to growth ratio, brings in a company's projected earnings growth rate.
So if a company has a super high PE ratio, but also crazy high projected growth, the PEG ratio helps put things into perspective.
Yeah, exactly. A low PEG ratio might suggest the company's growth potential isn't fully reflected in its current price. It's a way to look ahead, not just at the present.
Okay. Now my brain is starting to hurt just a little bit, but we're not done yet. We still have a few more on our list from the source material. PCF ratio, PBV ratio, EV assets. You want to run through those real quick?
You got it. So the PCF ratio, or price to cash flow ratio, focuses on a company's cash flow, which some investors see as a more reliable indicator of financial health than just earnings.
Okay, interesting.
Then there's the PBV ratio, or price to book value ratio. That compares a company's market value to its book value, which is basically the value of its assets minus any liabilities.
Church.
And last but not least, EV assets helps you figure out how efficiently a company is using its assets to, well, make money.
Wow. Okay, so many ratios.
Yeah.
If I were in that interview, I think I'd maybe pick one or two of these and explain why they'd be especially useful in specific situations. Like if a company has a ton of tangible assets, EV assets would be a pretty important one to look at, right?
For sure. You don't need to memorize every single ratio out there. It's more about demonstrating you get the point of them and you can pick the right tool for the job,
Yeah.
showing you can actually think critically about this stuff.
Right. It's like I'd be way more impressed as an interviewer if someone could do that than if they just rattled off a list of definitions.
Oh, absolutely.
So what we've really learned here today is that context is key.
Definitely.
Knowing when to use each multiple, what their weaknesses are, and connecting it all back to the bigger picture. That's the real deal. That's what makes a real financial analyst.
Couldn't agree more. So to all our listeners out there prepping for those finance interviews, remember, understanding these ratios is just step one. The real skill is knowing how to use them.
Couldn't have said it better myself. Today we are tackling something that might sound a little intimidating at first, but stick with us.
Yeah.
We're going to make it not only clear, but actually pretty interesting.
Heck, I could do that.
Yeah.
Absolutely.
We're talking about WACC. That's the weighted average cost of capital. Now, whether you're, prepping for a tough job interview, digging into a company's financials, or just kind of curious about how businesses make big decisions, understanding WACC can be a real game changer.
It really can.
Yeah, and it's one of those things, you hear these terms thrown around in the business world, and you're like, ooh, that sounds complicated.
Oh, yeah.
Once you break it down, it's not that scary. Plus,
Yeah.
it can unlock some pretty cool insights into a company's, financial health and strategy. So
Absolutely.
let's say you're in that hot seat,
Mm.
right, in a job interview, and the interviewer hits you with, okay, explain WACC and tell me why it matters.
Oh, that's a classic.
Right.
Yeah, it is a classic.
How would you handle that?
Well, I'd start by, taking a breath
Sure.
and explaining that WACC is really at its core the average rate that a company can expect to pay for all of its funding sources. Think of it this way. Companies need money to operate and grow, just like all of us. And they get that money from different places. Investors who buy their stock, that's equity.
Mm.
They take out loans, that's debt. And
Mhm.
sometimes they issue preferred stock, which is kind of in between the two. And each of these sources of funding has a cost.
So it's kind of like when we think about, our own personal finances, it's like figuring out the average interest rate we're paying on all of our loans,
Right.
but for a whole business.
Right. That is a great way to put it. Exactly. And just like we want to keep our interest rates low, companies want to optimize their WACC.
Right.
A lower WACC generally means they can get funding cheaper,
Yeah.
and it makes it easier to invest and grow and potentially make more money.
It's like a measure of efficiency almost, right? Like
Yeah.
how well they're managing their cost of capital.
I like that. Yeah, efficiency. That's a good word for it.
Okay. So we've established that it's a pretty important concept. But how does this WACC, number actually help companies make these like big decisions?
Let's imagine a scenario where a company's considering, say, launching a new product line. Okay, they're going to estimate how much profit they think they can make from this new product line, right? But they also need to know their WACC because that's essentially the cost of the money they're going to use to make this new product line happen.
Right, right.
So if their projected return on this investment is higher than the WACC, that's a good sign. It means that the project is potentially worth the risk.
Mm-hmm.
But if the return is looking like it's going to be lower than the WACC, then it might be too risky, right? It might not be worth it.
It's a benchmark.
Yeah,
It's a way to see, okay, is this worth it or is this too risky?
absolutely.
But how do we actually,
benchmark is a great way to think about
yeah, get to this magical number? Like, how do you calculate it?
Well, that's where the formula comes in. And I know it can look a little bit technical when you first see it, but we're going to break it down, I promise.
Okay.
Basically, what we're doing is looking at each source of funding, right? The proportion of equity the company has, the proportion of debt, the proportion of preferred stock in
Mhm.
any, and we're going to multiply each of those by its respective cost. So we need to figure out the cost of each piece.
Okay. So break that down for me. Like when we say cost of equity, what does that even mean?
Good question. The cost of equity is essentially the return that investors expect to get for owning a piece of the company. They're taking on risk, right? They're investing in this company, and they expect a certain return for that risk.
Mm.
And one common way to calculate that cost of equity is by using something called the capital asset pricing model, or CAPM.
No, there's another one. Another one of those intimidating finance terms.
Oh, no, I know.
Yeah.
I promise it's not that bad. Here, think of it this way. A company's risk is like a roller coaster ride. The riskier the ride, the higher the reward you expect for getting on that ride.
Okay.
Same thing with investing. The riskier the company, the higher the return investors are going to want.
Oh, I like that.
Okay.
So a well-established company, one that's been around for a long time, probably has a lower cost of equity than, say, a brand new startup that's just,
Yeah.
getting off the ground. There's more uncertainty.
Exactly. Precisely. You got it.
Okay.
Now, on the debt side, things are a little more straightforward.
Okay.
The cost of debt is basically the interest rate that the company is paying on its loans.
Straightforward. Makes sense. And then we talked a little bit about preferred stock earlier. What about the cost of that?
That's similar to debt in that it has a fixed dividend payment rate.
Mm-hmm.
So you would look at the dividend rate and the current market price of that preferred stock to figure out what its cost is.
Okay, so we've got all the pieces now. We've got the cost of equity, the cost of debt, and the cost of preferred stock. So that's everything we need, right?
Got all our ingredients, yeah.
You mentioned detective work earlier, though. What did you mean by that?
Right. So, calculating WACC isn't just about plugging numbers into a formula. There's some real analysis that has to happen, some judgment calls,
Right.
especially when it comes to figuring out the cost of equity. We got to look at market data. We got to look at comparable companies. We got to factor in risk, all those things to come up with a good, accurate estimation.
So it's like a puzzle. You got to find all the pieces and put it all together.
It is. It is. It's a financial puzzle.
So let's go back to our interview scenario. Right? We've
Yeah.
got this question about WACC. How do we, tie it all together and impress our interviewer?
Well, you could say something like, understanding a company's WACC is really important for making smart decisions about investments and strategies. It helps the company figure out how much their capital is costing them, and it helps them see whether or not a project makes sense financially.
Hmm.
You could even talk about how WACC helps companies compare different ways to finance things, or even how it helps them understand the overall risk of their business.
Boom. Mic drop. You just showed them you know what you're talking about.
Right.
That's pretty impressive. Okay, so I think we've covered a lot here. Any final thoughts for our listeners before we wrap up?
Yeah, I would just say, think about this. WCC can actually give you a glimpse into the future direction of a company.
Hmm.
So if a company has a really high WACC, it might mean they're taking on more risk. Maybe they're trying to grow really fast.
Yeah.
But a company with a lower WACC, that might mean they're more focused on stability, maybe paying dividends to their shareholders. It's really a fascinating metric to look at when you're trying to understand what a company is all about.
It's not just a number, right? It tells a story.
Exactly.
Yeah. So I know a lot of you out there are probably prepping for some pretty tough finance interviews, right?
Yeah, definitely. Especially this time of year.
It's one thing to, understand financial analysis on paper, but when you're in the hot seat
Yeah.
and they start grilling you with questions,
Oh, yeah, it's totally different.
it's like, how do you explain it clearly and confidently when the pressure's on?
Right. It's like, how do you prove you can actually apply all that knowledge?
Exactly. So that's what we're diving into today, right?
Absolutely.
We're going to break down how to actually explain these complex financial concepts in a way that wows the interviewers,
And we're going to focus on what you shared. You mentioned step-by-step financial modeling techniques.
Yeah, that was one thing I saw that just, it always makes me nervous just hearing that phrase.
Oh, I totally get it. It sounds super intimidating, but it doesn't have to be.
So help me out here. How would you actually explain that in an interview? Like, what are the steps?
Okay, well, first, I'd start by, explaining how to organize all the company's historical
Yeah.
financials. You got to put them in a standard format so you can work with them, right?
Right.
Then I'd talk about how you project those financials using the 3 core financial statements, the income statement, balance sheet, and the statement of cash flows.
Makes sense. But it can't be that simple, right?
Yeah.
Like, you're not just plugging in numbers.
No, you got to go deeper than that. You need to show them you can actually analyze, right?
Yeah.
So I'd also talk about building out these supporting schedules to dive into specific areas.
Oh, okay.
Like you could mention a debt schedule and how you'd analyze like different interest rate scenarios,
Yeah.
right?
Gotcha. So you'd be showing them you can think critically about how different factors impact the company's, valuation.
Exactly.
Okay. Now, this is where I always get stuck DCF analysis. I never know how to explain it concisely.
DCF, yeah, that's a tough one for a lot of people. I think the key is to focus on the why of it,
The why? Okay.
not just the what. So you could say something like discounted cash flow analysis. It helps us figure out a company's present value by looking at its future cash flows and discounting them back to today. But then you need to really show them you understand the details, right?
Right. Like, you're not just pulling numbers out of thin air.
Exactly. So you could mention how important it is to choose the right discount rate based on the company's risk and market conditions, things like that.
Okay. Because picking a random discount rate won't impress anyone.
No, definitely not.
Now, you also mentioned FCFF and FCFE earlier.
Mhm.
I always mix those up. What's the difference, and why does it matter in an interview setting?
Ah, that's a great question. See, knowing the difference between shows that you understand different investor perspectives. So you could say, if we're looking at the value of the whole company, we'd use free cash flow to the firm. But if we want to know the value for equity holders specifically, we'd use free cash flow to equity.
Mm.
And then you could even give them like a quick example of how, using the wrong one could really mess up your analysis.
I see. So it's all about showing that deeper level of understanding, right?
Yeah, exactly.
Okay, so we've talked about the technical stuff, but how do you explain all this without making the interviewer's eyes glaze over?
Well, You got to think of it like telling a story, right? Make it relatable. You could use analogies or real-world examples.
Okay, I like that. Give me an example.
Sure. Think about DCF like investing in a rental property. You're paying a price today for the rental income you expect in the future, right? Then you discount that future income back to today to see if it's a good deal.
Oh, I love that. That makes so much sense. So it's about practice, clear explanations, and a bit of storytelling, it seems.
Pretty much.
All right, so let's be honest. Sometimes finance jargon can be a bit like trying to decipher a secret code,
Absolutely.
right? And there are definitely a few terms out there that can make anyone's eyes glaze over.
Uh-huh.
But today we're tackling one that you definitely don't want to just skim over, especially if you're prepping for a big finance interview.
Yeah.
We're doing a deep dive on free cash flow to firm,
FCFF.
FCFF, exactly. And we've got some great source material that walks us through how to explain it and even how to calculate it.
Right.
But let's face it, formulas and definitions are only part of the story.
For sure.
In an interview, you want to show that you really get it right.
Yeah, absolutely.
So our mission today is to break down this concept in a way that's clear, concise, and dare I say, even a bit engaging.
Yeah, I like that.
So let's jump right in. Our source kicks things off with the definition. FCFF is the surplus of cash that remains after taking into account working capital requirements, as well as the costs of maintaining and renewing fixed assets.
Okay, so maybe not the most exciting sentence ever.
It is a mouthful. But if we had to distill it down to like a key takeaway, what would you say is the essence of FCFF?
Well, I think the key here is that it's about the cash that's left over.
Okay.
The cash that's left over after a company has taken care of its essential operational expenses and investments. And importantly, this is cash that can benefit both debt and equity holders.
Got it. So it's not just about profit on paper, it's about the actual cash a company has at its disposal.
Exactly. It's about looking beyond the accounting numbers to understand a company's real financial strength.
Okay, so now let's shift gears a little and think about why this even matters.
Yeah.
Like, why should we, or more importantly, why should someone in a job interview care about this leftover cash?
Well, think of it this way. FCFF is a company's financial fuel. It's what gives them the flexibility to grow their business, pay dividends to their shareholders, or even reduce their debt. It's a really powerful indicator of their financial health and their potential for creating value.
Oh, okay, so it's like a window into both their present situation and their future possibilities.
Exactly. And that's something any savvy investor or potential employer is going to be interested in.
Absolutely. Now, our source also mentions something called non-cash charges. What exactly are those?
So non-cash charges are expenses that get recorded on the income statement, but don't actually involve any cash leaving the company in the current period. Like think about depreciation.
All right.
When a company buys a big piece of equipment, like let's say a delivery truck, they don't deduct the entire cost of that truck up front. Instead, they spread the cost over the truck's useful life, which could be several years. And that spread out cost is what we call depreciation.
So it's more of a way of accounting for the gradual wear and tear on an asset over time.
Exactly. It's an accounting concept rather than an actual cash outflow.
Makes sense. So how do we actually go from this general idea of free cash flow to, actually crunching the numbers?
Well, the good news is there's a formula for that. But hold on. Before you start memorizing equations, remember that in an interview setting, it's not about reciting formulas by heart. It's about showing you understand what those formulas actually mean.
Okay, so walk us through the logic. What are the key ingredients in the FCFF recipe?
All right, so we start with EBIT, which stands for earnings before interest and taxes. And this represents a company's operating profit. Now, we got to adjust that for the tax rate. Uncle Sam wants his share.
Right.
Then we add back those non-cash charges like our friend depreciation, because remember, they don't impact today's cash flow.
So we're basically trying to strip away all the accounting noise to get to the real cash the business generated.
Precisely. And from there, things get a little more interesting. We got to consider changes in working capital.
Okay, and just as a quick reminder for anyone who needs it, working capital is basically the difference between a company's short-term assets and its short-term liabilities, right?
Right. Think of it like this. An increase in working capital means the company needs more cash to keep things running smoothly, while a decrease means they've got more cash freed up.
So it's about managing the cash that flows in and out of their day-to-day operations.
You got it. It's like running a coffee shop. If you suddenly stock up on a ton of coffee beans, that's going to tie up a chunk of your cash in inventory.
And if you can convince your suppliers to give you a bit more time to pay your bills, You get to hold on to that cash a little longer.
Exactly. Managing working capital efficiently is key to maximizing free cash flow.
Makes total sense.
Yeah.
Okay, so we've covered operating profit, taxes, non-cash charges, working capital. What's the final piece of this puzzle?
The last thing we need to factor in is capital expenditures, or CapEx for short. This is the money a company spends on those big ticket items like property, plant, and equipment. These investments are absolutely essential for growth, but they do represent a cash outflow.
Okay, so to recap, we begin with operating profit, adjust for taxes and non-cash charges, factor in the ebb and flow of working capital, and then finally subtract those long-term investments.
And voila, that gives us our free cash flow to firm.
Fantastic. Now, circling back to that interview scenario, how can we explain this all in a way that shows we're not just number crunchers, but that we actually understand the why behind the numbers?
You could say something like, FCFF is a valuable metric because it helps us understand how much cash a company has left over after covering its essential expenses and investments. This leftover cash gives them the flexibility to pursue growth opportunities, reward their shareholders with dividends, or even reduce their debt.
That's a great way to tie everything together and demonstrate that you grasp the bigger picture.
And, here's a little bonus tip for you. Two companies in the same industry might have very similar earnings, but their free cash flows could tell very different stories.
Oh, interesting. How so?
It all comes down to how efficiently they manage their working capital and their investment strategies. So FCFF can help you go beyond just surface-level earnings and really assess the quality of a company's profitability.
That's incredibly helpful. So to sum it all up, we've learned that free cash flow to firm is more than just a fancy finance term. It's a vital metric that reveals a lot about a company's financial health and potential.
And we've even explored how to calculate it and, more importantly, how to explain it in a way that shows real understanding, which is what really matters in those high-pressure situations, like a job interview.
Exactly. And before we wrap up, any final words of wisdom to leave our listeners with?
Yeah, I'd say this. When you're researching companies or preparing for an interview, don't just stop at the FCFF number itself. Dig a little deeper. Ask yourself, why is that number what it is? Look at their working capital trends, their investment decisions, and how they're using their free cash flow to create value for their shareholders. That's where you'll find the really juicy insights.
That's a great point. So there you have it, folks. You're now equipped to tackle those tough interview questions and impress even the most seasoned finance pros. Until next time. We're all about helping you prep for those big equity research interviews.
That's right. So you've been studying, you're feeling good about your knowledge, but how do you make your answers really stand out?
Yeah, how do you really shine?
Right.
Well, today we're diving into an excerpt that I think is super relevant. It's all about financial modeling.
Oh, definitely. And as you know, it is a big deal in this field.
A huge deal. You can't get away from it. Now, the source material here makes a really good point. It says that financial modeling isn't just about, crunching numbers. It's about building a story from a company's history.
It's about taking that history, those past financials, and, projecting them forward.
Right, it's like forecasting the future, and that's what I think is so fascinating about it.
Absolutely, because it's that story that investors are really looking for.
Yeah, they want to see the whole picture.
Exactly, but being able to build that story, build the model, and explain it, that's what really shows expertise in an interview.
Okay, so let's get into the nitty-gritty. What are those core things that interviewers want to know you understand?
Okay, well, the excerpt talks about the big three financial statement.
The essentials, right?
Right. The balance sheet, the cash flow statement, and of course, the income statement.
You got to have those down.
Oh, absolutely.
Yeah.
But you also have to be able to go deeper. The source mentions other parameters.
Like what? What are they talking about there?
Things like ratios, earnings per share. Those are your analytical tools. So let's say you're asked about a company's profitability.
Okay.
Yeah. So you could talk about the net income, but to really impress them, you need to go further, calculate the profit margin.
Right. Show them you can do more than just read a number off a statement.
Exactly. You can compare it to previous years or even look at industry benchmarks. Now, that's what's going to make them take notice.
That's insight. That's what they're looking for.
Yeah.
So when you're prepping for these interviews, it's not just about memorizing definitions. It's about knowing how to use the information.
Exactly. You have to think about how you'd apply these metrics in the real world in an actual analysis.
Okay, so give me an example. Let's say they ask about a company's growth prospects. What would be a really insightful answer?
Okay, so instead of just saying revenue is increasing, which anyone can see.
Right, that's surface level.
Exactly. You could actually build a revenue model.
Oh, wow. Right in the interview.
Well, maybe not literally build it right there, but you can talk about how you would project revenue out a few years based on their current situation,
Okay, that makes sense.
and then explain your assumptions.
No, that's important.
Are you assuming they're launching new products? Are they expanding into new markets?
Oh, I get it. So you're really demonstrating strategic thinking.
That's what you want to showcase, your ability to connect those financial models to real-world events and make
Right.
predictions.
That's brilliant. But let's be real. No model is perfect, right? There are going to be things you can't predict.
Exactly. And that's a great question to bring up yourself in an interview.
Oh, you mean like address the potential weaknesses of a model?
Exactly. It shows you're thinking critically.
Okay, I like that. So what kind of things could you mention?
Well, you could talk about how models are based on assumptions,
Yeah.
and sometimes those assumptions don't hold true.
Right. Things changed.
Yeah.
Yeah.
You could also mention things like economic conditions, like a sudden recession
Oh,
or changes in regulations, stuff like that. These are all external factors that could impact a company's performance.
so it's not about pretending your model is some kind of crystal ball.
No, it's about showing you're aware of the limitations and being prepared to adjust your analysis accordingly.
That shows real depth. You're not just blindly following the numbers.
Right, because financial modeling is a really powerful tool, but at the end of the day, it's just that, a tool. It's your insights and how you apply those insights that will really land you that job.
This has been so helpful. I love how you've connected everything back to the interview itself,
Of course, because that's what we're all about here.
helping you succeed. So to all you future analysts out there, remember, don't just show them the spreadsheet. Tell them the story.
And good luck.
That's all the time we have for this deep dive, but I hope you found this discussion as useful as I did.
And remember, while financial models are a powerful tool, they're only as good as the assumptions they're built on. So always be sure to dig deeper, think critically, and most importantly, don't be afraid to ask questions.
Until next time. Today, we're tackling something that's, well, pretty fundamental for any investor out there, trailing and forward PE ratios.
Yeah, PE ratios, they're everywhere, right?
Seriously, everywhere. But getting a solid grasp on how they work, especially the difference between these two types,
It can make a real difference.
big time. So we've got some great research lined up, some articles that really dig into this. But
Uh-huh.
before we get lost in the jargon, maybe could you just break down what a PE ratio is at its most basic?
Sure, sure. Think of it like this. It's essentially the price you're paying for every dollar of a company's earnings.
Okay, so like the higher the ratio, the pricier the company.
Exactly. It's all about how much the market values a company relative to its earnings. It helps us understand, is this company overvalued, undervalued? How does it stack up?
Got it. So then what's the deal with trailing versus forward?
Right. So trailing PE, that's looking backwards. It's using earnings from the past 12 months to calculate the ratio.
Ah, makes sense. Historical data.
Yep, exactly. But then you have forward PE, and this is where things get, well, a little more interesting because it's based on, future earnings.
Predictions. Crystal ball stuff.
Kind of, yeah. It's relying on projections for the next fiscal year, usually based on analyst estimates.
Okay, I can see how that gets tricky. I mean, predicting the future, that's never a sure thing.
Definitely not. There's inherent uncertainty there, right? Analysts can be wrong, markets can shift unexpectedly, all sorts of factors can influence future earnings.
So let me ask you this. If forward PE is based on these, maybe not so reliable predictions, why even bother with it? When would you use it?
It's a good question. It's not about choosing one over the other. It's about using both to get a fuller picture. Trailing PE is great for understanding a company's historical performance, their track record.
There's solid ground what they've actually achieved.
Right. Forward PE, though, that gives you a sense of market sentiment. It tells you what investors are expecting in the future.
So like if a company has a high trailing PE but a lower forward PE,
That could suggest the market's anticipating a slowdown, maybe some headwinds coming their way, competition, changing industry dynamics.
interesting. And what about the opposite? High forward PE but a low trailing one.
That could signal a potential turnaround, some big growth expected down the line, a new product launch, expanding into a new market, something like that.
It's all about context then. Looking at both those PEs together to get a better sense of the whole story.
Absolutely. And remember, PE ratios are just one piece of the puzzle. They're a starting point.
Right, like you wouldn't buy a house based solely on its price per square foot. You'd look at the neighborhood, the condition, all sorts of factors.
Exactly. Same with investing. You got to look at a company's financials, their management team, the industry they're in, the overall economic climate.
So much to consider. PE ratios, though, they're definitely a key piece.
Mm,
Helps you start asking the right questions.
for sure. They're like a lens, to help you focus on what really matters when you're evaluating a company's potential.
Totally. Now, here's something to think about as you're doing your own research. If these forward PEs are based on analyst predictions, how can you tell if those predictions are any good? Are they just throwing darts at a board?
That's the million-dollar question. It's all about understanding their assumptions, digging a little deeper into their methodology. And that, my friend, is a whole other deep dive.
Definitely something to keep in mind. All right, folks, that's it for today's deep dive on trailing and forward PE ratios. Remember, knowledge is power, especially when it comes to investing. So keep learning, keep exploring, and we'll see you next time for another fascinating deep dive.